We also did something to do with the piecemeal or the stage acquisition, where we said that this whereby the parent company has acquired the control or acquires control in the subsidiary through several purchase of shares. Equally, we did a question as far as that is concerned. In our previous class, we looked on how to prepare the group accounts whereby we have a disposal of interest. And actually, we say disposal of interest is whereby the parent company has sold some of the shares, or basically all the shares which are held in a subsidiary. So I think we did a question on partial disposal, but because of time, we are going to do another question on that, but not now. During our revision, we're going to do a question on full disposal, because in terms of how we prepare the group accounts, whereby we have a full disposal, I hope you can be able to recall what we said. We account for a subsidiary which has been fully disposed as a discontinued operation. We have to compute its profit or loss before it was disposed, and also the profit or loss arising from the disposal. And actually, we said that one should be recognized as a separate item within the consolidated statement of financial position. So during our revision, automatically we're going to do a question on full what disposal. So make sure you remind me on the same during our revision. So today I want us to basically proceed, and we look on this. I think should be the last concept before we look on the group cash flow. I want us to look on what is known as the overseas. Overseas. In other terms, we refer to this as a foreign subsidiary. A foreign subsidiary. And in this case, the standard which is applicable here is International Accounting Standard number 21, IS 21, overseas, or basically a foreign subsidiary. So first of all, we need to ask ourselves here, what is an overseas, or basically what is a foreign subsidiary? So this basically a subsidiary which is operating in a country different from the parent company countries of operation. Like in this case, we may be told that a company which operates in Kenya has acquired a subsidiary which is either operating in Uganda, in TZ, or maybe like in Rwanda. So that particular subsidiary is operating in a different country from the parent company countries of what? Of operation. So such a subsidiary, we refer to it as an overseas, or basically a foreign what? A subsidiary. So therefore, this is basically a subsidiary company which is operating in a country different from the parent company country of operation. Country of what? Of operation. Country of operation. For example, in this case, we may be told that a company which is operating in Kenya basically has acquired a subsidiary which is, for example, operating in what? In Rwanda. So the parent company operating in Kenya, the subsidiary is operating in what? In Rwanda. So this is basically a foreign, or basically overseas what? A subsidiary. Now, in this case, how do we prepare the group account here? The first thing which is important for us to appreciate here is that the Kenyan currency basically is the Kenyan shillings. What is the name of the currency for Rwanda? The currency for Rwanda is known as what? Who can tell us here? The currency for Rwanda. The currency for Rwanda is known as what? Who can tell us? The currency for Rwanda. So the currency for Rwanda is known as Rwandan franc. Is known as what? Rwandan franc. Just like if you go to TZ, their currency is Tanzania shillings. If you go to Uganda, their currency is Ugandan shillings. If you go to Rwanda, they use a currency known as Rwandan franc. Rwandan franc. So basically, you can see that these two companies here, they basically prepare their financial statement using a different currency, using a different what? Currency. So this one, the parent company prepares financial statement using the Kenyan shilling, this one using the Rwandan franc. It is obvious that if you are preparing the group accounts, there is no way you can do a direct consolidation. You can do a direct consolidation. You take the asset and liabilities, revenue and expenses of the two companies, you combine them. You can't do that because you can see those currencies are different. The financial statement of the parent company is prepared in Kenyan shillings, and the financial statements of the subsidiary are prepared in what? In Rwandan francs. So in this case, we are going to look on how do we translate, how do we do the translation. But even before we do that, we look on that, maybe there are some two terms we need to define here. One is something called a presentation currency, the presentation currency, and also something called the functional currency. The functional currency. So when we talk about the presentation currency, this is basically the currency which is used by the parent company in preparing the group account. The currency used by the parent company, currency used by the parent company, to prepare the group accounts, to prepare the group what? Account. In most of the cases, if the parent company is a Kenyan company, this one will be preparing the group account in Kenyan shillings. If the parent company is a Kenyan what? Company, it will be preparing the group accounts using the Kenyan what? Shillings. But that currency used by the parent company to prepare the group accounts is called the presentation currency. On the other hand, when we talk about the functional currency, this is basically the currency, the currency of the primary economic environment, in which a company operates, in which a company operates, in which a company do what? Operates. So basically that local currency of the country in which the company operates. So if the parent company is operating in Kenya, the functional currency is Kenyan shillings. If the subsidiary is operating in Rwanda, the functional currency or the local currency for that country is Rwandan what? Is Rwandan franc. So therefore, in this case, when preparing now the group accounts, we are saying, before we proceed basically to do the consolidation, before we proceed to add assets, liabilities, revenue, and expenses, those of the parent company, this particular foreign subsidiary, it is important for the financial statements of the foreign subsidiary to be translated into the presentation currency. Into the presentation what? Currency. Remember, you say the presentation currency is that particular currency which will be used by the parent company in preparing the group account. If the parent company is operating in Kenya, it will prepare the group account using what? The Kenyan shilling. So therefore, before we combine similar items of asset, liabilities, revenue, and expenses, those of the parent company, those of the foreign subsidiary, asset, liabilities, revenue, and expenses of this company, that is a foreign subsidiary, must be translated into Kenyan shillings, which is the presentation what? Currency. So how do we do the translation? These are the translation rules. These are the translation rules. These are the translation rules. And this basically what is very, very important you need to remember. Number one, when translating the items of incomes and expenses, and remember in this case, what we are translating are the incomes and expenses of this foreign subsidiary. So we translate them. They are translated. Items of incomes and expenses are translated using something called the average exchange rate. The average exchange what? The average exchange rate. Because in both of these particular questions for foreign subsidiary, you'll be given usually 3 exchange rates. You'll be given the exchange rate at the start of the year, the exchange rate at the end of the year, and also will be given the average. So in this case, we translate incomes and expenses of this foreign subsidiary using what? Using the average exchange rate. The average exchange rate. Number 2, when translating the assets and liabilities of the foreign subsidiary into a presentation currency, these ones are translated using the crossing exchange rate. The crossing exchange rate. This is actually the exchange rate at the end of the year. The exchange rate at the end of what? Of the year. So if you're able basically to know that, then this particular question, or the question for preparation of group accounts whereby we have a foreign subsidiary, they become very, very simple. But it is obvious that in the process of translating the assets, liabilities, revenue, and expenses of this foreign subsidiary into a presentation currency, there is something which is known as the translation, or basically, yes, the translation currency difference, or can we just refer to it as the exchange difference? Exchange difference. In other terms, we refer to this as the currency translation difference. Translation difference. Currency translation difference is basically an exchange difference which arises from translating the items of asset, liabilities, revenue, and expenses of this foreign subsidiary into presentation currency, of which in this case we are going to see this currency translation difference, or this exchange difference, can either be a gain or basically a loss. Can either be a gain or a loss. Now, this particular gain or loss, we can say this arises. This
Good evening, class. Good evening, class. Good evening, class. Good evening, class. Thank you. Thank you, thank you, thank you. So we are the guys who have been blessed to be in class today. So we fold our sleeve and we start. So we fold our sleeve and then we start. So where did we stop? Where did we stop? So there was a last statement, made a number of statements, just a recap of those statements. That in case of, for example, I'm just reminding us of what we said. We say that when you look at water pumps, and generator, we basically say that under manufacturing, we basically grant them investment allowance at the rate of 50% in the first year, 25% on a straight line per annum. That is from the second year on the remaining balance. From the second year on the remaining balance. And lastly, we were saying that in case of, let's say, for example, in case of hire purchase, Let's say you buy an asset, you buy what you call an asset on what you call hire purchase. If you buy an asset on hire purchase, the value that basically qualifies, we say that the value that basically qualifies, if you buy an asset on hire purchase, the value that qualifies for investment allowance is what's called the cash price. Cash price is what qualifies. We say qualifies for what you call for investment allowance. Cash price is what qualifies for investment allowance. We say ignore what you call the hire purchase. So what qualifies for investment allowance? It is the cash price. And we do what? We ignore what you call the hire purchase. It is the cash price that qualifies for investment allowance. We ignore what we call the hire purchase. Together, team. What qualifies for investment allowance in case of hire purchase? It is the cash price. So if an examiner brings a question and gives you the hire purchase and the cash price for a fixed asset, the value that definitely qualifies for what we call the investment allowance, we say is the cash price. Cash price is what qualifies for what we call investment allowance. Perfect. So then how do you get investment allowance? We say that investment allowance is equals to investment allowance or wear and tear. In case of wear and tear, we say that wear and tear rate, wear and tear rate, wear and tear rate, wear and tear rate. Then you say times wear and tear rate into brackets, because initial value, we are not using written down value because nowadays they're basically on a straight line. Initial value, then you say plus additions minus what you call the disposal minus the disposals together. This is how we basically calculate what we call the investment allowance for wear and tear. So the wear and tear rate either is 25 or 10% times into bracket. We say the initial value plus what we call additions. These are assets that have been bought during the year. Then you less assets that have been basically disposed during the year together. Then you less the assets that have been disposed during the year. You give me a yes if you're together. You give me a yes if you're together. Perfect. Then say the following values. You say the following values we say are used. We say the following values are basically used as addition. We say during what we call the year. So the following values, we use them as addition during the year. The following values, we use them as addition during the year. One, we say if you buy an asset, we say the purchase cost plus cost incurred. We say before the machine is put to use, plus the cost that is basically incurred before the machine is put to use. We say that the costs that are basically incurred before the machine is put to use, we have installation, i.e., we call it installation cost, installation. We have the taxes, what we call the taxes paid. We have the taxes paid, e.g. we have VAT, and what we call the custom duties, etc. VAT and the custom duties, etc. We also have the transportation cost and exemptions. We also have the transportation cost and etc. So if you purchase an asset, that will be during the year, that will be the value of addition plus the cost that are incurred before the machine is put to use. I have talked about installation taxes paid, like VAT and the custom duty, but you also have the transportation cost together. We also have the transportation cost together. We respond with a yes, if that is at home. We give it a yes if that is at home. So then we say the second scenario, say in case of a trade-in, what we call a trade-in situation, in case of what we call a trade-in situation, in case of what we call a trade-in situation, in case of a trade-in situation, the value of the new asset, we say that the value of what we call the new asset. So the value of the new asset, we say that the value of the new asset, brought in, we say qualify as addition. So in case of a trade-in, we basically say that the value of the new asset that is brought in qualifies to be what we call addition, qualifies to be addition together. The value of the new asset that is brought in, that is what is going to qualify as an addition. You give me a yes if you're together. Perfect. Then say, we say in case of hire purchase, in case, we just put in case of what we call hire purchase, in case of what we call the hire purchase, in case of the hire purchase transaction, in case of what we call the hire purchase transaction, in case of the hire purchase transaction, we say cash price, we say is used and we ignore what we call the hire purchase, and we basically ignore what we call the hire purchase. That in case of hire purchase, cash price is used, and we ignore the hire purchase. Then we lastly, as an NB, that is an addition, we say that for SUV and what we call saloon car, for SUVs and what we call the saloon car, for SUVs and what we call the saloon car, SUV, if the value, we say exceeds 3 million, if the value basically exceeds 3 million, we restrict, we say to 3 million. So when you buy an asset, and that is the addition. In case of SUV, those are sport utility vehicle, Mercedes-Benz, Land Cruiser, and saloon car. We're basically saying that if the value exceeds 3 million, we restrict to 3 million. We respond with a yes. We restrict to 3 million. Give me a yes if you're together. We basically restrict to 3 million. Perfect. So then the last part is on the disposal part. The last part is for disposal, we say the following qualifies, we say to be what we call the disposal, qualifies to be disposal value. That for disposal, the following qualifies to be disposal value. Number one, that will qualify to be disposal value, we call it sales proceed. We call it sales proceed. of an asset. So the value that you get when you sell an asset altogether, the value that you get when you sell an asset, that will qualify as the disposal value. Together, team, that in case of disposal, the sales proceed, the value that the asset has been sold qualifies to be the disposal value together. In case the sales proceed of an item, the number two is say, for an item stolen, for an item stolen, for an item that is stolen, or we say involved in an accident, for an item that is basically stolen or involved in an accident, we say insurance, we say that insurance compensation, we say qualifies to be what it qualifies to be the disposal value. Make sure those concepts are at the back of your mind. Let's say, for example, you had an asset, and you're saying that, for example, for an asset that is stolen or involved in an accident, the disposal value will be what you call the compensation. The insurance compensation qualifies to be the disposal value. For an asset that is stolen or was involved in an accident, the value that is compensated by the insurance company is what qualifies to be the disposal value. You give me a yes if we are together. That value qualifies to be what we call the disposal value. Perfect. Thank you so much. Then the last item before we get to the question. For saloon cars, then say for saloon cars and what called the SUVs, for saloon cars and SUV, for saloon cars and SUV, if the value, we say, was restricted, if the value was basically restricted, if the value was restricted, if the value was restricted, when added, say, when added, we say disposal value, we say is determined as follows. So if you're disposing an asset that was basically restricted, an asset that was restricted during addition, are we together? So the disposal value should also be restricted. I am saying that if when you're adding an asset, the asset was restricted. It therefore goes that when you're disposing, the asset should also be restricted. So how do we get the disposal value in that case? So we say that the disposal value, i.e., we say disposal value, the disposal value should be what we call the sales proceed. That is just the SP, sales proceed. The disposal value should be the sales proceed over what you call the initial cost. Then you say times restricted value, which is 3 million. Are we together here, team? I want us to understand this. That if basically, we are saying that if basically you are disposing an asset that was restricted when you are adding it together, therefore it goes that when you're disposing also that asset, you need to restrict. How do we restrict? We say the sales proceed over what we call the initial cost, that is the buying price, then you multiply by 3 million. This will not qualify as what? As the disposal value, but you restrict. What you get is what you get as the disposal value, Tubonyeza yes, kama tuko sawa. Tubonyeza yes, kama tuko sawa. If you're together, we respond with yes. If we are together, we respond with yes. Perfect. Then I only have to make one statement. In case of trade-in, in case of what we call the trade-in, the disposal value, when you're talking about trade-in, in case of trade-in, the value of the old asset is deducted as the disposal value. You're saying that in case of trade-in, we say that in case of trade-in, lastly, we say in case of what we call of trade-in, the value of what we call of the old, the value of the old asset, we say qualifies as what we call as the disposal value. The value of the old asset qualifies as what we call the disposal value. So that is that. I want us now to go to the practical work. Is there any question before I get to the practical work? Kuna mtu ana swali? Is there a question? Kuna mtu ana swali? Can I proceed to the questions? Can I proceed to the questions? Can I proceed to the question? Is there any question regarding, we move on, perfect. So I want the first question. I want us to start on the first question. I want us to pick on December 2024. December 2024. I want us to pick on December 2024. December 2024. That is question 4C. December 2024. We start with the first question, DEC 2024. Question 4C. DEC 2024. Question 4C. Are we on it? Let's start with that question. DEC 2024, question 4C. DEC 2024, question 4C. If you're there, you respond with a yes. DEC 2024. So perfect. So I want us to read that question. So we're being told, Adam Mwema, the examiner tells us that Adam Mwema, a retired engineer, Adam Mwema, a retired engineer, sets up a manufacturing factory in industrial area on 1st January 2023 to fabricate mechanical and automotive parts at a cost of 44,900,000. At a cost of 44,900,000. So then the examiner tells us the operation commenced on 1st January, that is 2023, except for commercial building, which was put into use from 1st September, except for the commercial building, which was put into use on 1st September. So then you're given the breakdown for the manufacturing. So the breakdown of 44,900,000. Number one, you're being told that the factory building that is 18 million. Which investment allowance does it qualify for? Factory building. Factory building, it qualifies at which rate? Which investment allowance and at what rate? Factory building, which investment allowance and at what rate? Which investment allowance and at what rate? Factory building. Which investment allowance does it qualify? At 50%, we call it ID, but you say at 50% in the first year, then you say 25% on a straight line, 25% on a straight line. That is from the second year on the remaining balance. Number two, we call it office within factory building. Office within the factory building. How would you treat that? Office within the factory building. Office within the factory building. When you say office within the factory building, office within the factory building, what does it qualify? At what rate? That's a commercial property. So it qualifies for investment allowance at the rate of? At what rate does it qualify for investment allowance? At the rate of, we say at the rate of 10% on a straight line. You mark them. If you have a physical paper, you mark it them. Then the next we have what's called second-hand imported machinery. Second-hand imported machinery. Second-hand imported machinery. Second-hand imported machinery. So what does it qualify for? The second-hand imported machinery. For the second-hand imported machinery, it qualifies for which investment allowance? Second-hand, remember this is manufacturing. The second-hand imported machinery qualifies for ID. We understand at the rate of 50%, that is in the first year, then 25% on a straight line per annum, that is from the second year on the remaining balance. Then you have the next, what you call land. Land, does land qualify for investment? And which investment allowance does the land qualify for? Does land qualify for investment allowance? Land, does land qualify for investment allowance? Does land qualify for investment? No. Land does not qualify for any investment allowance. So that we are not going to use. The next we have what we call engineer fee for machine installation. What we call the engineer's fee for machine installation. Engineer's fee for machine installation. Engineer's fee, that is ID, at the rate of 50% in the first year, 25% per annum on the straight line. That is from the second year on the remaining balance. The next is what we call the parking bay. Parking bay. Parking bay. Parking bay. What does the parking bay basically qualify? Parking bay. That is also investment allowance at the rate of 50% ID, at the rate of 50% in the first year, 25% per annum on the straight line. That is from the second year on the remaining balance. Then the next we have what we call conveyor belt. Conveyor belt, Matsura. Conveyor belt, Matsura. Brand conveyor belt, what does it qualify for? Conveyor belt. Conveyor belt. Conveyor belt. Conveyor belt. Conveyor belt. So which investment allowance? That is at the rate of 50% in the first year, at the rate of 50% in the first year, and 25% per annum on a straight line. That is from second year on the remaining balance. Then lastly, we have commercial building, and the figure is 10 million. Commercial building, what does it qualify for? Commercial buildings. Commercial buildings. Commercial buildings. Commercial buildings. 10%. 10%. Thank you so much. So I proceed to the additional information. Alan, Ida, thank you so much. I proceed to the additional information. On the additional information, we've been told that commercial building, we are given a breakdown. Commercial building include what we call a showroom. So the figure of 10 million, we can put it as probably working commercial building, commercial. We have it as a commercial building. The figure is 10 million. From 10 million, this one includes what we call showroom. So we have the showroom. We have what we call the showroom. And the showroom and retail. Showroom is 2.8. 2.8. Then we have what we call retail shop. What we call the retail shop. So retail shop is a figure of 3.2. So what is the figure for the commercial building? What is the figure for the commercial building? What is the figure for the commercial building? So what is the figure for the commercial building? If you less that, what is the figure for the commercial building? So when you less that, what is the figure for the commercial building? Because this figure is inclusive of a showroom and retail shop. So what is the difference? Is the difference 4 million? Is the difference 4 million? Perfect. Showroom and retail shop, they qualify for investment allowance at what rate? Showroom and the retail shop, they qualify for investment allowance at what rate? Showroom, they qualify at 10%. At 10%. So that is analyzed. So then you're being told that factory building include a warehouse. So there's a working two. We have the factory building. What is the figure for the factory building? What is the value for the factory building? What is the value for the factory building? What is the value for the factory building? What is the total value for the factory building? So that was a figure of 18. We had it as 18 million. But we've been told that on this building, on this factory building, there's what we call, there's a warehouse. So we need to less that warehouse. We need to less that warehouse. And the figure is 2.2. The figure is basically 2.2. So what is the factory building? The figure for the factory building. What is the figure for the factory building? The figure for the factory building. Give me the figure for the factory building. Provide me the figure for the factory building. Provide me the figure for the factory building. The figure for the factory building. Provide me with the figure. So this is 15,800,000. Aida tuko sawa? Aida, are we together? Perfect. Abia. Edith, I hope we're together. So this warehouse, what will it qualify for? If we less it, warehouse will qualify for? The warehouse will qualify for investment allowance, that is IBD. We understand at 10%, at 10%. IBD at the rate of 10%, at the rate of 10%. IBD at the rate of 10%. So we proceed to the next. The examiner tells us that additional information number 3, a building that had been constructed, a building that had been constructed, a building that had been constructed at a cost of 12 million was leased to Juhudi Manufacturers Limited. A building that had been constructed for a figure of 12 million was leased to Juhudi Manufacturers Limited for 5 years. So being told that annual lease rental was agreed at 2.2. 𝐼𝐍𝐹 imported the machinery from China at a cost of 5.2 and installed it in the building and started operation. Do we grant investment allowance for the building that you've leased? Do we grant investment allowance for the building that you basically leased? Do we grant investment allowance for a building that you have leased? Do we grant investment allowance for a building that you basically leased? Either. Do we grant investment allowance for a building that you basically leased? No, we don't grant. That's why if you have options, in order for you to qualify for investment allowance, you buy instead of leasing altogether. If you want to qualify for investment allowance, you buy instead of leasing. Are we together? If you lease, you're only going to be entitled to what we call the lease rental, rentals as allowable expense. But if you have the option to lease or buy in order to qualify for what you call investment allowance, in order to qualify for the investment allowance, in order to qualify for the investment allowance. However, what about the imported machinery of a figure 5.2? Is it going to qualify for investment allowance? The imported machinery for 5.2, is it going to qualify for the investment allowance? Is it going to qualify for the investment? Yes, that imported machinery is going to qualify for the investment allowance. Yes, that is going to qualify for the investment allowance. So that is sorted. All of us, are we together? All of us, are we together? Perfect. So then I proceed to additional information number 4. So the examiner tells us to improve the performance of the factory. We are being told that to improve the performance of the factory, 𝐼𝐍𝐹 computerized operation at a total cost of 15 million. 𝐼𝐍𝐹 computerized the operation at a cost of 15 million, out of which 30% was software related. So out of which, so we have computers, and then we have the softwares. We have what's called the software. So the figure is 15 million. But the examiner tells us that basically 70% was the computer. So 70% times 75% times a figure of 15 million. So what is 70% times a figure of 15 million? Because that's what 70%, then 30% was in relation to software. 30% was basically in relation to the softwares. 30% was basically in relation to the software. Just a minute. Give me a few minutes. Sorry for the interruption. So then 70% is basically in relation to the computers. So what is 70% of 15 million? Give me 70% of 15 million. 70% of what I call 15 million. So that should be 10, 500. What I call the 500. We have it as 500. What about the 30% that is in relation to the software? 30% that is in relation, that should be 45. That should basically be 45. So computer software and computers, they qualify for investment allowance. Number one, computer and computer software, those are wear and tear. At what rate? Those are basically wear and tear at what rate? Wear and tear at what rate? At the rate of 25%. At the rate of 25%. Training at the rate of 25%. not 10%. Training that should be wear and tear at the rate of 25%. So then the examiner tells us on additional information number 5, that the following assets were also purchased. The following assets were also purchased. We say on 1st July 2023. Number 1 is furniture and fitting. Number 1 is furniture and fitting. What does it qualify for? Furniture and fitting. 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 What does furniture and fittings qualify for? Investment allowance at the rate of 10%. Investment allowance at the rate of 10%. At the rate of 10%. What we call investment allowance at the rate of 10%. At the rate of 10%. The next is the second-hand BMW vehicle. Second-hand BMW vehicle. What does it qualify for? The second-hand BMW vehicle. The second-hand BMW vehicle. The second-hand BMW vehicle. 25. But what do we do to the BMW? There's a concept that we have not remembered. What do you do? The BMW Nini, that's an SUV. So what do? We restrict to 3 million. The amount that is going to qualify for wear and tear should be, that should be 3 million. We restrict to 3 million. Then the next, we're being told that 4-ton lorry, a figure of 1.8. 4-ton lorry, a figure of 1.8. The 4-ton lorry, figure of 1.8. What does it qualify? 4-ton lorry. A 4-ton lorry. Investment allowance at what rate? At the rate of 25%. Thank you, Gabu. Then we have the next, that is what we call the backhoe loader. Backhoe loader. What do you call the backhoe loader? So backhoe loader. What do you call the backhoe loader? Backhoe loader. The backhoe loader. At what rate? That's wear and tear. But at what rate? Wear and tear 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 at what rate? Not 10%. Backhoe loader, that should be 25%. Note it as 25%. As 25%. As 25%. Either that should be 25%. Is that okay? Either that should be 25%. Either is that noted? Either that should be 25%. That should be 25% together. That should be 25%. Matsura, that should be 25%. So then we have the next is mobile crane. Mobile crane. Mobile crane. So the mobile cranes. Mobile crane. Mobile cranes. Mobile cranes. Mobile cranes. Mobile cranes. Thelma, why did you say that? Mobile cranes. That's not a trailer, the smaller trailer. Mobile crane. Mobile crane. Galma, you are missing it. Mobile crane. Mobile crane should be 25%. Team, that should be 25%. 25% together. Mobile crane should be 25%. 25% together should be 25%. 25%. Tuko sawa. To give me a yes kindly. Then lastly, we are being told that the factory, the examiner tells us that the factory staff labor quarters were constructed during the year at a cost of 2,250,000 and put to use on 1st October 2023. Factory staff quarters. How do you treat the factory staff quarters? How do we treat the factory's staff quarters? Factory staff quarters, that's IPT, at the rate of 10%, 10%, at the rate of 10%. I know you wonder why I chose on this question. I particularly chose on this question because people did not perform well in this particular question. This is one of the questions that was poorly performed. So before I put it down, we're not going to break before we finish. Before we put it down, please, you see there's wear and tear here, number 5 from 1st July. And we have the labor quota that is for the IBD. We are being told that from what? That is from October. We don't apportion. Please don't apportion. Please don't apportion. Is that okay? Do not apportion. Claim the whole amount. Claim the whole amount. Together. Do not apportion. Claim what we call the whole amount. Do not apportion. Claim what we call the whole amount. Do not apportion. Claim what we call the whole amount. So do not apportion. Claim the whole amount. Is that point at the back of our mind? Pardon. Is that point at the back of our mind? Perfect, if that point is basically at the back of our minds. If that point is basically at the back of our mind. So when it comes to investment allowance, I can use 2 methods of doing it. I can separate them, or I can use them as a whole. I've said when it comes to investment allowance, I can basically separate them, or I can do what? I can separate them, or I can carry out investment allowance as a whole, together team. Then I can decide to just accumulate the whole amount and carry out the investment allowance, or I can decide to do them separately, or I can decide to basically do them separately. Are we together? So the both methods, I will apply them, but for this first question, I will do it separately. For this first question, I will do it separately. We don't prorate. We don't prorate. Don't prorate them. That's why I'm doing this question, Galma. Yes, because majority of the students failed in this question. And the reason why they failed is because they prorate this. So then we don't know that Adamil Mwema, we call it the Adamil Mwema, and we understand that this is investment allowance say for 2023. Adamil Mwema. And we have what's called the investment allowance for 2023. Adamil Mwema, and then we have investment allowance for 2024. for 2023 together. That is what the examiner compute investment allowance due to Adam Mwema. So the first method, I am doing it separately. So I start with ID. I call it ID. So investment deduction at 50% in the first year, 25% per annum on the straight line, that is from the second year. So investment, we call it the investment deduction. We call it the investment deduction. We call it the investment deduction. So we separate them. So say nature of the asset, nature of what we call the asset, nature of the asset. We have the qualifying cost. Nature of the asset, we have the qualifying cost. We have what we call the ID rate. ID rate. We have the ID rate. And then we have what we call the ID amount. And then we have what we call residual. That is the balance, though not necessary because they're not moving to the second year. So we start with the first item. The first item is what we call the factory. We have it as the factory. We have it as the factory building. So what is the value for the factory building? Factory building from our working. What is the figure for the factory building from our working? Nataka watu wakuwe rada. Factory building. Tumepata ngapi? From our working, the figure for the factory building, that is 15,800,000. The ID rate for the first year is 50%. So what is the amount? 50% of that is what figure? 50%. How much is 50%? ID amount, 50%. Watu wangu, 50% of that. Chukua calculator. Chukua calculator na ufanye. That is 7.9. 7.9. So then the residual is 7.9. So that is the first one. So next is what we call second-hand imported vehicle. What we call second-hand. We call it imported vehicle. So the second-hand imported machinery, sorry, not vehicle, machinery. That out. Machinery. That is 4.4. The figure is 4.4. What is 50% of 4.4? 50% of 4.4. So 50% of 4.4, that should be 2.2. That should basically be 2.2. This is 2.2. That should be 2.2. 2.2. Then we have land does not qualify. We go to engineer's fee. We call it engineers. Engineers fee. We call it for installation. So why do we put there? These are the costs that are incurred before the machine is put to you. These are costs that are basically incurred before the machine is put to use. So that is 1.4. 50%, 700. Then we have a figure of 700. Then we have a figure of 700. Then we have what's called the parking bay. Parking bay. We have the next what's called the parking bay. So parking bay is a figure of 900,000. 50%, 950%, we have 450, and then the balance is 450. I hope we are moving on well. Then you have conveyor belt. So the conveyor belt is 1.4. 50% of that should be 700. 700. That should be 700. So conveyor belt, we have 1.4, 50% of that should be 700. We respond with a yes. That should be 700. Together, 700. That should be 700. Tuko sawa. Kuna mtu ako nyuma. Is there anybody behind? So commercial building, those are not ID. So we turn the pages. So the next ID is what we call imported processing machinery. Imported, we call it imported processing, we call it machinery. So imported processing machinery, the figure is 5.2. Are we in agreement that the figure is 5.2? Are we in agreement that the figure is 5.2? Are we in agreement that the figure is 5.2? Imported machinery. Are we in agreement that the figure is 5.2? 5.2. If we are, then that should be superb. So that is 50%. This should be 2.6. 2.6. The balance is 2.6. Is there any item for ID that we've not added? Is there any item that we've not added? Is there any item that I've skipped? Is there any item that I've skipped? Is there any item that I have skipped? Is there any item that I have skipped? Is there any item that I have skipped? So there's not an item. So we call it, this is summary, we call it the total ID. So what is the total summation for the ID amount? Total ID, summation for the ID amount. Total summation for the ID amount. Total summation for the ID amount. Total summation for the ID amount. So somebody gets it 14,550. 14,550. So that is the total for ID amount. What are the entries? It's in your answers. 1, 2, 3, 4, 5, 6. Those are the entries together. So then I proceed to the next. I proceed to the next. I proceed to the next. So the next is we can go to the IBD. Those are industrial building deduction. IBD we know at the rate of 10%. At the rate of 10%, we have what we call the nature of what we call asset. So nature of the asset. We have qualifying cost. We have the IBD rate. We have the IBD rate. We have the IBD amount. And then we have what we call the residual. And then we have the residual. So on this, we have office within the building. So we have office. So the qualifying cost for office, that should be 800,000. The rate is 10%. What is that? The rate is 10%. What is 10% of that? What is 10%? Give me that. What is the rate? So that should be 720. That should be 720 as a balance. The next we have commercial. We have a commercial building. So commercial, through our working, we divided that as 4 million. So 10%, don't apportion. You don't apportion 10%. So that is 400. Together. Tuko sawa. And today you're not responding. Are we together? Training. Tuko sawa. Training tuko sawa. Matsura tuko sawa. Brian, are we together? Kindly, when you don't respond, we are losing it on learning. So then the other breakdown, we had what you call, we had the showroom, 10%. So what is the difference as residual? 2.8 minus 2.8. Give me the difference. Then we have what we call retail shop. %, that should be 320. So give me the balances. Munipatie is the balances. $2 million. What about this? Is it this? Is that the figure? 2,880,000. Is that the figure? 2,880,000. Nimeshukuru, asante. So then we have what we call the warehouse. Warehouse. We had the warehouse. So what is the residual? What is the residual? What is the residual? Residual ni ngapi? Watu wengi wamekataa. Is it 1980? My people have rejected me. Are we having that? Then you had the staff quarter, labor quarters. Labor quarters, 2,250,000, 10%, that should be 225. So 225, what do you have? $25. So get for me the summary. Total, give me the total IPT amount. Nipatie your figure. Outcome is 80, 400 to 80, 320 to 20 to 25. That is a figure of 1,525,000. So these are the entries. That should be okay. Those are the entries. Tuko sawa? Munipatie, yes. Galma, kindly don't prorate. I've said kindly don't prorate. Prorate. What have I said? Kindly don't prorate. I have insisted, Galma, kindly don't prorate. Particularly for this question, the reason why students that in this particular year failed this question, because most of these questions, particularly this was the prorated, which get a Galma. Because of apportionment or proration, that's why majority of the students failed in this particular question. Yes, that's why majority, I will always tell you, because lazima tujenge wanafunzi wetu. Is that true, Galma? We must assist our students and make sure that they perform together. So don't prorate. Why did they fail in this? Because of that. That's why I insist, if you're looking at this, what people are doing in the internet, follow what I say. Are we together? You can check other things, but this one, just follow what I tell you. Yes, just follow what I tell you. Can I have this? Can I run? So that we do the last part of it. Can I run? So, Ida, in my class, that's what I told you, particularly for this, Ida, you don't prorate. With the changes that were expected, you don't prorate. Ida, don't prorate kindly. Sawa, Ida. Yes. Mwalimu atakutetea. No, I'm joking. Yes, don't follow what I say. Just follow what I say. I cannot lead you to a wrong direction. Mwalimu will always lead you to the right direction. I know that's a concept that majority, you pick a paper, especially a paper like this, and then you realize it because they prorate and then they miss marks on that. So then we go to wear and tear. I say these things can be done in one, can basically be done in a single. Are we together? We can do this, Galma. We can even do this as a whole. We don't need to separate, but I said we separate. Then the next question we'll do as combined together. We do as combined. So we have the last one that is wear and tear. The last one is wear and tear. The last one is wear and tear. The last one is basically wear and tear. So the last one is basically wear and for the last one is wear and tear. So we have what we call wear and tear, wear WTA. So that is wear and tear. WTA, that is wear and tear. So we have what we call nature, or what we call asset. Asset. What we call the nature of asset. We have the nature of asset. We have qualifying cost. Qualifying cost. We have what we call wear and tear at 25%. We have wear and tear at 10%. Then we have ARC, residual. Then we have the residual. Hapo tuko sawa. Hapo tuko sawa. If you're there, we pick the first one. So we have the furniture and fittings, furniture, and what we call fittings, what you call the furniture and fittings. So the qualifying amount is 620. So the qualifying amount is 620. That is wear and tear at 10%. So what is 10% of 620? We understand not here. 10% of 620. 10% of 620. That should be 62. So 620 minus 62, what is the residual? 620 minus 62. 620 minus 62. 620 minus 62. Don't know the math because even if you put it residual, but we put it, that's not where the max is. So that should be 588. So then we move to the next, we have second hand and BMW. So we say restricted. So the figure is restricted. So we restrict it to 3 million. We restrict it to 3 million. That should be wear and tear at 25%. So this is a dash. So this should be 750. So 750 minus 3 million and 5% is 750. What is the difference? We restrict because that's an SUV. SUV. So you restrict. SUV, restrict, restrict, restrict. So this is 2 million. Should be 2,250,000. So then we go to 4-ton lorry. 4-ton lorry. What do you call the 4-ton lorry? So the 4-ton lorry was 1.8. So what is 25% of 1.8? 25% of 1.8. 25% of 1.8. What is 25% of 1.8? 25% of 1.8. 25% of 1.8. Now, I'm on this idea and your figure. So then that should be 450. So what is the residual? That should be 13. We have it as 1350. We have it as 1350. Then the next we have what we call backhoe loader. Backhoe loader. Backhoe loader. So we're having a figure at 680. So what is 25, 20? Oh, 558. Thank you. 558. So what is 25% of 3680? 5% of 3680. So that is 920. So what is the residual? Residual negative if you less that. Residual negative. That's okay. Then you have the next, we have the mobile crane. So the mobile crane is 1 point. What is 25% of 25% of that? In 5% of that. So 475. So what is the balance? What is the residual? Perfect. So then we have computers and computer. That is 10. Then you have the computer software. But some people are doing them as a whole. Some people are basically doing it as a whole. Some people are separated. So what is 25% of 10? 10% of 10, 500. What is 10% of 10, 500? So that's 1425, say 1425. Balance, what is the balance? So what is 25% of that? Of 4.5. 25% of 4.5. 25% of 4.5. Computer is 25%. Computer is 25%. Galma, computer is 25%. So this should be. So what is the residual and residual debt? Somebody lied to me. Somebody has already lied to me there. Huh? So what is the balance? So get our summary. Summary for this, then we do the summary for the whole thing. 𝐎𝐍𝐿. So you're saying the figure is 3375. 33. Is it 3375? Hey guys, I'm saying this addition. I don't think so. So that's 6345. So Galma, are you able to see this particularly Galma and IDA? The students who basically prorated, that is IBD and wear and tear, they got 0 in all this thing. Are we together? IDA and Galma. For those students who basically prorated or apportioned, this particular question they got is 0. Are we together? Because this was now, because it was from 1st July, this got 375, this was 225, this was 460, this was 237, this was also this one was for the whole year. So maybe this was the only thing that the student got. What are the entries? 1, 7, 8. Then you do the summary. We can now have the summary. So what the ID? ID was how much? IBD, then wear and tear, 5. Then we have what's called wear and tear 10%. So what was the figure for the ID so that we have our summary? figure for the ID. ID ilikuwa ni ngapi? ID ilikuwa ni ngapi? ID ilikuwa ni ngapi? So that's 14 by 15. IBD was how much? IBD was how much? IBD was how much? IBD was how much? That's 1525. Then this is 63, 45. So get for me that summary. Get for me the summary. Do for me that summary. Summary, get for me the summary. So there's 22,482,000. So look up. Hapa tuko na inchi ngapi? 2, 3, 4, 5, 6, 7. So 7, we add 7 plus 7 under, then plus around maybe 3. So any 1 times, the question was 12, 1 times any 12? 12. 1 times any 12. Is that understood? Has it been understood? Is the question understood? That is how we have it. But I was particularly saying that this information, I can be able to combine all these things. And do it as one. I don't have to separate them. I can as well decide to combine that information and carry out what we call the investment allowance. I can as well combine the whole thing and carry out the investment allowance. So we can have our break now. We can have our break, then we come back. Is there any person who has a burning question? So God bless you once again. Keep safe and have a great, great evening. And for my audit students, I was requesting that we meet in the evening at 8. Jaffa, I don't know whether Jaffa has indicated, but I was requesting that instead of early morning, we meet at 8 to around 9:30 time. That is for the audit students. As Jaffa deliberates with you people, note that Malimu is requesting that tomorrow, instead of meeting very early in the morning, we meet at around 8. So you can go, you can do your personal studies very early in the morning, then we meet at 8 in the evening. Jaffa, he was supposed to communicate that. So we close it there. We close it there. We close it there. Thank you.
entity on 1st of April 2024. So then we are told that the acquisition consideration comprised of an immediate cash payment of 2,400 million made on 1st of April 2024, and a further consideration of 1,331 million deferred until 1st of April 2026. This is what we refer to as the deferred what? Consideration. And then you're told no accounting entries have been made in respect of the deferred cash consideration. 𝐓𝐿 Limited has a cost of capital of 10%. And then you're told on 1st of October 2024, 𝐓𝐿 Limited together with another entity entered into a joint arrangement to jointly control 𝐶𝐶𝑠 Limited, a public limited entity, public limited entity. Effectively, 𝐓𝐿 Limited purchased 50% of the equity shares of 𝐶𝐶𝑠 Limited for an immediate cash payment of 1,500 million. The following financial statements relate to the group of companies. So we are given the statement of profit or loss, basically for 3 companies, 𝐓𝐿, Pepper, and 𝐶𝐶𝑠. We have the statement of financial position for the 3 companies, that is 𝐓𝐿, Pepper, and 𝐶𝐶𝑠. And then we have some additional information. This was actually one of the simplest questions, which has been tested in advanced level for group account. So we're given additional information. You can see actually the additional information, we're just given like 4 additional information. Then what are we required to do? At A, we're required to prepare the consolidated statement of profit or loss for the year which ended 31st of March 2025, the consolidated statement of financial position as at the same date. Now, before we do that, automatically this is a question for group account. The first thing we need to do is we come up with a group structure. We know the relationship, the nature of investment by the parent company in the other companies. We go through the additional information as we do or maybe we do any working which is necessary. So we go straight to the workings, and basically the first working here will basically be to come up with a group structure. To come up with a group structure. That's the first thing you always need to have in any question for group accounts. The group structure. So where do we have the information about the group structure? This information, we have it within paragraph 1. Let's go back to paragraph 1 of our question, and we are told the company which is called 𝐿𝐿 Limited, a public limited entity, acquired 80% equity shareholding in a company which is called Pepper, a public limited company on 1st April 2024. So the company which is called 𝐿𝐿 Limited, this company acquired 80% equity shareholding in a company which is called Pepper Limited, on which date? 1st of April 2024. 1st of April 2024. It basically means that 𝐿𝐿 is the parent and then Pepper is the subsidiary. You can see also we're given the date of acquisition. Then from there, once we go to the paragraph number 3. Let's go to paragraph 3. We skip paragraph 2. In paragraph number 3, we are told on 1st of October 2024, 𝐿𝐿 Limited, our parent company, with another entity entered into a joint arrangement to jointly control 𝐶𝐶𝑠 Limited, a public limited entity. Effectively, 𝐿𝐿 Limited purchased 50% of the equity shares of what? Of 𝐶𝐶𝑠 for an immediate cash payment of 15. So this company here, we are told acquired 50% shareholding in a company which is called 𝐶𝐶𝑠 Limited. 𝐶𝐶𝑠 Limited on which date? 1st of October 2024. 1st of October 2024. So it basically means that from this group structure, this will be our parent company, this will be our subsidiary, and basically this one will be a joint venture. That one would be a joint what? A joint venture. So that is the first thing you always need to have, because this is basically what will guide you in terms of how to prepare the group account. So if we go to the requirements, therefore, we are required to prepare the consolidated statement of profit or loss, consolidated statement of financial position. So in preparing those consolidated financial statements, we will add similar items of assets and liabilities, those of the parent, those of the subsidiary. That does not apply to the joint venture. For the joint venture, in the consolidated statement of profit or loss, we will compute the parent company share of profit after tax, another comprehensive income, and also we compute something called the investment in what? In joint venture, or the investment in joint arrangement. This one, we can also refer to it as a joint arrangement because the parent company have a joint arrangement with another company to control this, to jointly control that one. So I think we have that. Then we will be able to come back to that paragraph 2, because we have the aspect of deferred consideration, but we will only come back there when computing the goodwill. So that deferred consideration, remember we said we have to discount it to its present value using the parent company cost of capital. That's why you can see you're given the cost of capital of Block Limited. That is for the purpose of getting the present value of that. So I want us to go to the additional information now. Let's go to note number 1. And in note number 1, what are we told? We are told at the date of acquisition, the fair value of Paper Limited, remember Paper now is the subsidiary, Paper Limited net asset approximated their carrying amount with an exception of some office equipment whose carrying amount was 560 million below the fair value. And then you're told at this date, the office equipment had a remaining economic useful life of 8 years. And then you're told depreciation on office equipment is an administrative cost. And then you're told no fair value adjustment were necessary in the acquisition of CSAT. What does that mean? It means that on the date this company was acquired, that is the subsidiary company revalued the assets. The asset. And if you can be able to recall, we refer to that as the fair value adjustment or the fair value exercise. And actually, we said once the subsidiary company revalue the asset, the subsidiary company does not account for that revaluation. As a result of that, when preparing the group account, we talked about 2 key consolidation adjustments we make. The first one is called the revaluation adjustment, which is an adjustment relating to the revaluation gain, and the other one is depreciation adjustments, whereby we have to compute depreciation and the charge. So therefore, we need to do some working as far as that is concerned. Note 1 is concerned, which you are saying is a fair value adjustment, or basically the fair value exercise. Let's just refer to it as the fair value adjustment, and this is by Paper Limited. So we need to make 2 adjustments as far as this is concerned. The first one is called the revaluation adjustment. And basically, this is the adjustment in relation to the revaluation gain or loss. But remember, you said in most of the questions for group account, you will come across a revaluation gain. So that's why we are told in the first paragraph, in the first sentence of note 1, we are told at the date of acquisition, the fair value of Paper Limited net asset approximated the carrying amount with an exception of an item of office equipment whose carrying amount was 560 million below. So this one was below or was less than fair value with 560 million. In other terms here, we can say the fair value, we start with the fair value, then we change this inequality sign. Remember, this was less than. So we change this now to greater than. If we start with this, so this one will be greater than carrying amount with an amount of what? 560. So if the fair value of an asset is more than its carrying amount, automatically that is a revaluation gain. So the fair value of this item of office equipment was more than carrying amount. Remember, carrying amount, this one can also be known as the net book value with an amount of 560 million. So because this revaluation, okay, this 561, we are saying this is a revaluation gain. This is a revaluation gain by Paper. Did the Paper Limited accounted for this revaluation gain? No. So therefore, in preparing the consolidated financial statement, this one will be added to the group PPE. And number 2, we say that this one is a pre-acquisition revaluation reserve. Being a pre-acquisition revaluation reserve, we use that in the computation of goodwill, because we say in computing the goodwill on acquisition of this, we need to have we need to compute its fair value. We need to compute the fair value of its net asset on the date of acquisition. How do we compute that? We take the ordinary share capital of the subsidiary plus pre-acquisition reserves. This will be one of the pre-acquisition reserve. Next, we need to compute something called the depreciation other charge. other charge, and equally this depreciation other charge will be by paper, is by paper limited. So you need to recall the formula. There's a formula which I gave you here. That is basically what you need to remember. We said we take the revaluation gain, divided that with the remaining useful life of the asset, and then we multiply this with what? With the proportion of time. The proportion of time is basically the time we have, or basically the number of years, the number of months we have from the date of acquisition, the date of DOA, to the date of consolidation. Remember, the date of acquisition is the date the subsidiary was acquired. The subsidiary was acquired on which date? There, 1st of April 2024. The date of consolidation, this one, DOC, this is the date we are required to prepare the group accounts. And if you go to the requirement, you'll be able to see when are we required to prepare the group accounts as per the requirement. The year which ended 31st of March 2025. So that is the date of consolidation. And actually this year, because the year of the group is ending at 31st of March, it starts on 1st of April. So this year started on 1st of April, 2024. So therefore you can see our subsidiary here was acquired exactly at the start. Was acquired exactly at the start of what? Of the year. So therefore, the proportion of time we have here will be 1 year. Will be one what year? We're interested with the depreciation other charge for 1 year. We will take the revaluation gain, which we have here, 560 million. We are applying this formula. We divide that with the remaining useful life. And I hope you can see that within note 1. Can you see the remaining useful life? How many years? In note 1, remaining useful life. In note 1, how many years? Who can see that? Who can see that? Who can see that? 8 years. The remaining useful life of that asset. Can you see that? Should be 8 what? 8 years. 8 years. So we divide that with 8. And then the proportion of time here we are saying is 1 what? Is 1 year. If, for example, in our case, we had 6 months here, we had 6 months. So then the proportion of time here is always 6 over 12. If we had, for example, 2 years, we're interested in the depreciation other charge for 2 years. Our proportion of time should be 2. Should be what? 2. But in our case, we're interested with depreciation other charge for how many years? For 1 year. For 1 year. For 1 year. So this will give us 70 million. Now, this 70 million, which items will be adjusted here? One, this one will be deducted from the group PPE. When preparing our consolidated statement of financial position, we left that from the PPE. Number 2, we will also deduct this from the retained earnings of which company? Of paper. Retained earnings of paper. And number 3, in preparation of the consolidated income statement, because we are required to prepare that, the consolidated statement of profit or loss, this one will be adjusted where we have said any depreciation other charge should be added to the cost of sales unless otherwise. If you check on the information which are given in note number 1, we are told that depreciation of the office equipment is an administrative expense. Are we going to add this to the cost of sales? No. No. So in this case, we will add this depreciation other charge to what? To the administrative expenses. To the administrative what? Expenses. But if the question was cited, that one should be added to the cost of sales. So we are done with that. This is something which you have to understand, because in all questions for group account, you will come across this particular concept that the subsidiary company revalued the asset but never accounted for that. Which adjustments are required? 2, the revaluation gain and the depreciation other charge. Let's move to point number 2, where we are told 𝐿𝐿 Limited, which is basically the parent, measures the non-controlling interest in subsidiaries at the fair value. This is something I explained, that if you come across that information, that it is a policy of the group, it is a policy of the parent company to measure NCI at fair value, that information is basically to help you in computation of goodwill. And who can tell us, based on that information, which method are we going to use in the computation of goodwill? The goodwill on acquisition of this subsidiary. Which method are we going to use? Are we going to use the partial goodwill method? Are we going to use the full goodwill method? Which method are we going to use based on that information which we have there? Based on that information, which method are we going to use? Maureen, Georgina, which method? Benson, Gilbert, which method are we going to use? Automatically, we are going to use the full goodwill method. the full goodwill what method. That's why still in point number 2, we are told the fair value of the non-controlling interest of paper limited at the date of acquisition was 860. That is for the purpose of computing what? The goodwill. That is the NCI fair value. So no working which is required there. Let's move to point number 3. And you're told during the year which ended 31st of March 2023, Paper Limited sold goods to Rock Limited for shillings 500 million at a markup on cost of 25%. First of all, this goods which was sold by Paper Limited to Rock, this one we refer to that as amount of intragroup trading or intragroup sales. Intragroup trading. And basically we are told the goods which were sold by Paper to Rock, they had a value of 500 million. So basically we have said that these sales between the parent and the subsidiary are fixed sales. So therefore this one will be deducted from the group revenue. This one will be deducted from the group revenue. And number 2, we will also deduct this from the group cost of sales. Group revenue and also group cost of what? Of sales. So then in the same point, we are told half of these goods were still held by Rock Limited as at the end of the year, and the balance payable was still outstanding, and the balance payable was still what? Outstanding. Now, in that case, we have 2 adjustments here. The first adjustment is adjustment for unreleased profit and also adjustment for amount of intercompany debt. I want us, first of all, we deal with we compute the amount of unreleased profit, amount of unreleased profit. So unrealized profit on inventory. Remember, unrealized profit, we said arises whereby we have sales between the parent and subsidiary, and some of the goods sold to the buying company will not have been sold to third parties. In that point, we are told that this company, which is called Paper, our subsidiary, sold some goods now to Rock, but basically some of the goods remained in the inventory of Rock. They were not yet sold to third parties. We need to compute the unreleased profit, and this unreleased profit is always by the selling company. The selling company is this one. So this is unreleased profit by Paper. So how do we compute this unreleased profit? We take the unsold goods times the gross profit margin. Times the gross profit what? Margin. That is the formula you need to remember. The formula for computing what? For computing the amount of unrealized what? Unrealized profit. So let's proceed and we compute the unrealized profit basically by applying this formula here. We will take the unsold goods. And in that case, we are told the goods not yet sold at the end of the year were half. Half of these goods were still held in the inventory of Rock. The unsold goods will be half of the goods which were sold by Paper to Rock, which is basically 500 million. These are the unsold goods. The unsold goods, we multiply that with the gross profit margin. The gross profit margin, is it given? No. What we are given in our question, we are given the gross profit markup. Gross profit markup is 25%, which is basically the same with a quarter. Which is the same with what? A quarter. So having this, can we be able to determine the gross profit margin? Who can tell us which will be our gross profit margin here? Our gross profit margin, I'm told by Gilbert, will be 20%. As a fraction, it will be equal to what? As a fraction, automatically that one would be a quarter. And then to the denominator, we add the numerator. It will be 1/5. So this one will be, the margin will be 1/5. So how much will be our unreleased profit here? So it will be half to 50, and basically that will be 50 million. So this unreleased profit number 1, this will be deducted from the group inventory. In preparing our consolidated balance sheet, we let's start from the group revenue. Number 2, this one will also be deducted from the retained earnings of the selling company. The selling company is paper. That one will be deducted from the retained earnings of paper. And then in preparation of the consolidated statement of profit or loss, this one we have said should be added to the group cost of sales. To the group cost of sales. Those are the 3 adjustments which will be made as far as that and his profit is concerned. So we are done with point number 3. But even before you move to point number 4, in the last part of that, that point number 3, we are told and the balance payable was still outstanding. The balance payable was still outstanding. What is that? Balance payable was still outstanding. What is that? Who can tell us? Balance payable was still outstanding. Balance payable was still outstanding. Basically, that is the amount of intercompany debt. Now, if this company sells some goods to this, so it is obvious that this company, the parent company, should pay who? Should pay the subsidiary. But in this case, we are told the balance payable, was still what? Was still outstanding. So how much will be the balance which was payable? The balance payable. The balance payable should be what? The balance payable will be what? The balance payable here will be 500,000, 500 million, that is, because the amount of money which Lock Limited was supposed to pay paper was 500 million. So this amount is the one which amount to, or which amount to, or is the amount of intercompany debt. Amount of intercompany what? Debt. So in this case, it will be 500 million. So this one will be deducted from the group receivables, and also it will be deducted from the group what? Payables. Group receivables and group what? Payables. We move to point number 4, and we are told impairment review performed on 31st of March 2024, that is at the end of the year, basically reveals that both goodwill on acquisition and on paper limited and the interest in CISA were unimpaired. So the goodwill on acquisition of this, the investment in the joint venture were not yet impaired. So no working which is required. Number 5, incomes and expenses of the group of the companies are deemed to have accrued evenly throughout the year. So that information is always given such that if there is something you need to apportion on time basis or something you need to apportion, you apportion it on time basis. You apportion it on time what? Basis. And I think having said, there is something we need to compute before we proceed to prepare what is required. I want us to compute the goodwill on acquisition because there is something we will compute there. Let's first of all, we compute the goodwill on acquisition of this company here. Remember, I said we only compute the goodwill on acquisition of the subsidiary and we recognize that as an asset within the consolidated statement of financial position. The goodwill on acquisition of joint venture, the goodwill on acquisition of the associate is not computed and recognized as an asset within what? The consolidated statement of financial position. So let's compute the goodwill. The goodwill on acquisition of this company that is paper, paper limited, as per the information we have in note number 2, we are using the full goodwill method. We are using the full goodwill method, So here we need to have 2 columns. And our figures are in million of shillings. I hope you can be able to remember how we compute the goodwill using the full goodwill method. We start with the purchase consideration, which was paid by the parent company. The purchase consideration paid by the parent company. The purchase consideration paid by the parent company, this one is given within paragraph 2, paragraph 1 and 2. Let's go back to paragraph 1 and 2 of our question. So first of all, we go to paragraph 1. Actually, paragraph 2, not paragraph 1. Paragraph 2. We are told the acquisition consideration. This is the acquisition of the subsidiary. The acquisition consideration consisted of an immediate cash payment of 2,400 million. So the parent company paid the purchase consideration. The purchase consideration paid by the parent company was in two forms: the cash consideration, and I hope you can be able to recall, we say that this one do not have any special treatment. That amount we are going to use it as 2,400 million. So an immediate cash payment of 24. And this one, if you go to the balance sheet or the statement of financial position of the parent, and as a non-current asset, you should be able to see that amount. So the moment the parent company has paid some cash consideration in acquiring a subsidiary, that is accounted for as an investment in the statement of financial position of the parent. I hope you can see that, 24. And then we also have a deferred consideration. The deferred consideration. So the deferred consideration still in that paragraph 2, we are told an immediate cash payment of 24 and on 1st April 2024, and a further consideration of that 1331 million deferred until 1st of April 2026. No accounting entries have been made in respect of the deferred cash consideration, and lock limited cost of capital is 10%. These are deferred considerations which we said should be discounted to its present value using the parent company cost of capital. So we are going to discount that to the present value. So we will take 1331 and basically we discount this to the present value by multiplying that with the present value interest factor at the rate of 10%. And basically for how many years? How many years do we have from the date of acquisition? 1st of April 2024. This is the date of acquisition. That consideration will be paid on 1st of April 2026. How many years do we have here? How many years do we have there? Yes, we have 2. We have the first year which will end first, or basically 1st April 2025, 1, 2. So for 2 years. So this one will be computed like this. We take 1, remember the formula here, 1.1 raised to power negative 2. Yes, basically that's how we discount this. 1.1 raised to power negative 2, raised to power negative 2, raised to power negative 2. That's basically how we are going to discount that. Times 1331. And basically that one is coming to 1100. Is that what you're getting? 1100? 1100. 1100. 1100. Is that what you're getting? Diana, is that what you're getting? Georgina, is that what you're getting? Is that what you're getting? Yes. Okay, so then this is basically the purchase consideration paid by the parent. And then now to this, what do we need to do? We need to add the NCI at fair value. Remember, you're using the full goodwill method. The NCI at fair value, this one is given in note number 2. Is given in note 2. So the NCI at fair value is 860. 860. So we need to add those 3 values so that then we proceed and we less the net assets, which one? Acquired. And basically, I'm told that this one will give us 4360. 4360. Okay. So then to this, what do we need to do? To this, we need to proceed and we less the fair value of net assets which were acquired. So remember, you say that this is one of the items which the examiner will not have given you, and this whereby majority of the students have a challenge. How do we compute this? We say to compute this, we take the ordinary share capital of the subsidiary plus pre-acquisition reserves. Plus pre-acquisition reserves. So what we do, we have to go to the balance sheet of the subsidiary, specifically at the equity. Can we go to the balance sheet of the subsidiary? Subsidiary is paper, specifically at the equity. At the equity, we start by taking its ordinary share capital. Its ordinary share capital was, or is basically 2,000. Below that, what do we have? We have share premium. In this case, if you're given a share premium in the balance sheet of the subsidiary, and the question is cited, The question is what? Silent. We always treat that as a pre-acquisition. We always treat it as what? As a pre-acquisition. And then from there, we have the retained earnings. The retained earnings. But basically what we know is that retained earnings which we have there, that is the retained earnings at the end of the year. So what we are interested with here is the retained earnings on the date of acquisition, because this is a reserve. This is a reserve. We're interested with the retained earnings on the date of acquisition. And basically what we know, I've said that the retained earnings which are given there of 1,800, this is the retained earnings at the end of the year, 31st of March 2025. So we are interested with the retained earnings of paper on the date of acquisition here, 1st of April 2024. How do we get that? Very simple. Because one, we know the retained earnings of this company for the current year. In other terms, what is the profit after tax of paper? So the retained or the profit after tax of this company during the current year. So you get that from the income statement. Can we go to the income statement of paper? The income statement of paper, you tell me how much was its profit for the current year. How much is the profit after tax for the current year for paper? Can you see that amount? It is 520. It is 520. So how do we arrive at this value here, the retained earnings at the end? To arrive at this, we take the retained earnings at the start, which we don't have. We add this, we get this. Sasa, we take this plus this, we get this. What we are interested with is the retained earnings of this date. So can we be able to get this? Take into account to get this, we take this plus this, we get this. It's very simple. So to get this one, we will take this minus this, we get that. So therefore, the retained earnings at the start will be 1,800 minus 520. And this will give us 12 what? That will give us 1280. 1280. So 1280 is basically the retained earnings on the date of acquisition. And therefore, if you check there, we don't have any other reserve. But in all this particular question for group account, there is something you must always remember to check. Did the subsidiary company revalue the asset on the date of acquisition? If yes, was there a revaluation gain? Remember here, Paper Limited revalued the asset. There was a revaluation gain of 560, which we said is a pre-acquisition revaluation reserve. So we have a pre-acquisition revaluation reserve of what? Of 560. Yes, we don't have anything else. Let's get this total. Let's get this total. This will give us a total of what? This will give us a total of 40. So because you're using the full goodwill method, we take 100% of that. When using the full goodwill method, take 100% of this. We are interested with the net asset acquired by the parent and the NCI, parent and the NCI. So this will give us 40. So we less it from the figure we have up there, and basically we get the goodwill. We get the goodwill. So our goodwill will be what? Will be 320. Now, also you have to check, was this goodwill impaired? In our case, we are told as per the information we have in note number 4, the goodwill was not impaired. So I think having this now, I want us now we prepare what we are required. And because we have now the workings, all the workings, basically to prepare what is required should not take us a lot of time. So we go straight to part A, the consolidated statement of profit or loss. Let me just have that here. The consolidated statement of profit or loss, which is for the year, which ended 31st of March 2025. 31st of March 2025. Yes, so here we just need to have a single column, and basically we indicate that our figures are in million of shillings. So how do we prepare this? As per our group structure, we are basically combining the revenue and expenses of the parent, those of the subsidiary. We combine the revenue and expenses of the two companies. It is also important to note that this company, taking into account it was acquired exactly the start of the year, we will take the revenue and expenses of paper for the whole year. For the whole year, we combine with that of the parent. In our case, remember, we don't consolidate a joint venture. Instead, what we will compute is the parent company share of the profit after tax, and basically we recognize it what here. So let's do that now. So how to prepare this, we go to the statement of profit or loss for individual companies, which is basically given below paragraph 2. And we use the format which are given there. So we will start with the revenue. We take that of the parent, 520, plus that of the subsidiary, which is paper, 51 what? 80. So remember, we are not consolidating their joint venture. So and then to this, what do we need to do? We need to less any sales between the parent and the subsidiary. And I hope you can remember you have this intra-group trading of 500 million. We less it here. No any other adjustment. No any other adjustment. We get the final value. We try to hurry up so that we finish. Although I can see we have time. We have time. So once you get the answer, type it in the chat box. I'll be able to see it. So I'm told that will give us 13,200. 13,200. Someone else to confirm. Is it 13,200? Is it 13,200? Is it 13,200? Yes. So then below that, we take the cost of sales. We do the same. 5510 plus 3440. So to this, we have a number of adjustments to be made. One, we less this amount of intra-group trading, 500. 500. So we also have this depreciation. Okay, this one will not be adjusted to the cost of sales, but rather to the administrative. We have this and this profit of 50 to be added there. And I don't think we have any other adjustment. So we get the final value there. The final value. Final value, I'm given 85. I'm given 85. Okay. So we move and basically we compute the gross profit. So the gross profit here will be how much? How much will be our gross profit? The gross profit will be 47. So then to that we proceed and basically we add the distribution. I think before we add the distribution, we can do this. We need to compute the group share. The group share of Sisters Limited profit after tax. Remember, this is basically a joint venture. That's what we include here as far as the joint venture is concerned. So what do we need to do? Can we go to the income statement, to the statement of profit or loss of Sisters, and you give me its profit for the year or the profit after tax? The profit after tax for Sisters is how much? Is it 640 million? Yes, 640. Now, then we need to determine when was our joint venture acquired. You can see the date when it was acquired, this date here. 1st of October 2024. This is within the current year. The current year is added, the current year ended on 31st of March 2025. How many months do we have here? Are they 6? So we have October, November, December, January, February, March. 1, 2, 3, 4, 5, 6. So in this case, we have how many months? Yeah, are they 6? Are they 6 months? Do we have 6 months? I've said 1st of October 2024. So our joint venture was acquired 6 months to the end of the year. So the parent company will only be entitled to share profit from the date it acquired that joint venture. It will only be entitled to share profit for how many months? 6. That's why we have to compute profit of 6 months, and then we multiply that with the parent company shareholding in Sisters, which is 50%. That gives us now the group share of Sisters Limited profit after tax. You think this one should be 160. This one should be 160. And then from there, let's proceed with the expenses. The first expense we have there is the distribution cost. And I hope you can be able to recall that if you come across these always have 3 mark. No single question for group accounts will come across whereby the distribution cost is to be adjusted. This is always a free mark. We take 830, that of the parent, plus that of the subsidiary. No adjustment. We get the total, which will be 1,300. Which will be 1,300. Are you getting 13? Yes. So then below that, we have the administrative expenses. Administrative expenses, we take that of the parent, 860, plus that of the subsidiary, 520. And then to this one, we have to add this depreciation added charge of 70 over 70. Also, in case our goodwill was impaired, in case this goodwill was impaired, any impairment loss for the current year, we also include it within administrative expenses, but we don't have any impairment loss. We get the final figure, which will be what? Which I'm told is 1450. 1450. Is it 1450? Yes. So then below that, we don't have any other expense. Okay, there is something we will include here. That one, you have to be very, very keen to remember that. Because I hope you can be able to remember, we have this deferred consideration. You see this deferred consideration, basically this represents what the parent company will have to pay at the end of the second year. So therefore, once we have discounted this deferred consideration to its present value, we have to amortize it. In the process of amortizing a liability, there is something which arises, which is known as interest. If you're amortizing a loan, if you're amortizing even, for example, financial liability, there is something which is known as what? Interest. So that interest is basically recognized here as part of the finance cost. So the finance cost will basically be the interest on this deferred consideration. How do we compute that interest on the deferred consideration? On the deferred consideration, we take this amount which you computed here, the present value of the deferred consideration. And for us to be able to compute the amount to be recognized as an interest during the current year, we multiply this with the rate which you have used to discount, which is 10%. 10%. So this will give us 110. Now this 110 is the interest on deferred consideration. Interest on deferred what? Consideration. And then this interest basically should increase the value for this. So what I'm trying to avoid here is basically to prepare a amortization schedule, but I think I can do that very fast so that we understand amortization schedule. We are saying we should amortize this. You see, this is the deferred consideration at the start. This is like our own amortization schedule. You have a column for years, the liability at the start, the interest, the cash paid, and the liability at the end. No need of doing that because we know what we want to do. We want to compute the interest, which will be 10%. And then, is there any cash paid during the current year? No, no cash paid. So therefore, to compute the liability at the end of the first year, we take this plus this. Can you add for me that? So that you understand what we amortize this. So that will give us 1210. So in fact, when preparing our balance sheet, this is the value of our deferred consideration. The deferred consideration is a non-current liability, and that is its value at the end of the year. Then that would be the opening balance in the next year. And then we compute the interest, which is 10% of this. We did come to 121. Is that what you're getting? Yes. Now we know the deferred consideration, this one, will be paid at the end of the second year. So at the end of the second year, the company will pay 1331. And once you do that, then you should get 0 there. You should be able to get 0. Will you get 0? Yes. Are you getting 0? Yes. So this is how we amortize that word. That. So basically, in relation to this deferred consideration, 2 items. One, this interest is part of the finance cost here, which is 10% of 1100. And then when preparing our consolidated statement of financial position, this one will be recognized as a non-current liability. Sasa? Yes. So having that, then we can proceed and we compute the profit before tax. Give me the profit before tax now. The profit before tax down here. How much would be a profit before tax? This plus this minus the 3 expenses there. I'm told this one will be 2,000. I'm told that one will be 2,000. Will be 2,000. Then we list the other item, which is also always a 3 mark. Income tax expense. Income tax expense, also this one, is always a 3 mark. A 3 mark. So no question for group account whereby income tax will be having adjustment. You take that of the parent and that of the subsidiary. And this will give us what? This will give us 670. 670. And basically we get what? We get profit for the year. Profit for the year, which will be 680. Which will give us which will give us what? 1320, yes. So basically in our case, we are done, and that's what was required. The marks allocated there were 10. So this basically what was to give you what? 10 marks. You can see in that question, it basically means that for any correct item which you had here, basically should be 5 marks, because these 6 cannot be 10. Yes. So having that, let's move to part B. The consolidated statement of financial position. Consolidated statement of financial position is at 31st of March 2025. Okay, so we prepared this one. We just need to have a single column here. And what is basically important for you to remember is that here, or this one is basically prepared by just combining similar items of assets and liabilities, those of the parent and those of the subsidiary only. As far as the associate is concerned, CSAS, we will include something called the investment in associate. So let's prepare this one. We start with the non-current assets. So for the non-current asset, we will start with the PPE, the property, plant, and equipment. So, and basically we take that of the parent 4260 plus 3660. And then you have to recall, we have an adjustment to be made to the PPE in relation to this working. So we said this 560 will be added to the group PPE. And then this depreciation other charge of 70 will be deducted from the PPE. 2 adjustments here. 2 adjustments, we add the revaluation gain of 560, we less the depreciation other charge of 70. We get the final value there. The final value will be what? What will be the final value? The final value, I'm told by Gilbert, will be 8380. 8380. That is the same figure I'm getting from Diana. So then from there, below that, we have investment in paper, investment in CSAS. Remember, these are the purchase considerations which were paid by the parent company in acquiring shares of CSAS and paper. Do you include that here? No. In relation to the subsidiary, which is paper, what we include here is the goodwill. We include the goodwill on acquisition of the subsidiary, which is paper limited. And basically that's what we computed here, 320. 320. In relation to CSAS, which is the joint venture, we compute something called the investment. The investment in joint venture, or basically joint arrangement. I just refer to it as the joint what? The joint arrangement. And basically we recognize that here is an item of what? As an item of non-current asset. I want us to have the working here, because remember I've given you the format for computing this. How do we compute the investment in associate or joint venture? I said one, you take the purchase consideration which was paid, or the cost of investment. That is basically what we have within the statement of financial, or within the statement of financial position of the parent under the non-current asset. How much purchase consideration was paid by the parent company in acquiring the shares of the joint venture? That is 15. That is 15. And then to this we have said we add what? To this we have said we add the group share of the joint venture post-acquisition retained earnings. And basically take into account our joint venture was acquired during the current year, Sisters was acquired during the current year. The amount which we include here, which we have included here, that is now the same with the group share of the post-acquisition retained earnings of the associate. That is basically what we will add here, 160, this one. And then to this we less any impairment loss. And I hope you can be able to record in note number 4, we were told that in note number 4, you are told the goodwill on acquisition, the investment in associate had not impaired. They were unimpaired. So we don't have any impairment loss. And that will give us what? 1660. That will give us 1660. So that basically what we include there. Then from there we proceed and basically we record the current asset. So for the current asset, we are given the total. We will take that is 720. That is of the parent plus that of the subsidiary, 2270. And then in this case, you have to recall that inventory, receivables, cash, and bank balance are part of this. Any adjustment affecting this inventory and receivables should be made here. And I think you can be able to recall here, we have this and this profit, which we say should be deducted from the group inventory. Inventory is part of this. So we less and there is profit of 50. And also we have the amount of intercompany debt, this one, of 500. We also less it here. I don't think we have any other adjustment. So let's get the final figure. We get the final figure. I don't think we have any other adjustments. So what is the final figure here? I'm given 50, 440, 5440, 5440. Yes. So then what will be our total? What will be our total assets? What will be our total assets? You add all this, you give me the total assets. And because of space, I want to do away with this one. I want to do away with this one. Yes, the total asset in our case will be 15,800. I want to do away with this now. Yes. So then from this, we need to move. And basically, we record equity. So for the equity, we will start with the ordinary share capital. Ordinary share capital. And I hope you can be able to recall the ordinary share capital. We don't consolidate this. We only include the ordinary share capital, that of the parent company only. The ordinary share capital of the parent company only, which is how much? Which is 5,000. 5,000. Below that, what do we have? We have share premium. Equally, the share premium, we basically include that of the parent company only. That of the parent company only, which is 500. So below that, we have what? We have the retained earnings. So basically, retained earnings is one of the item which is a little bit tricky in terms of its computation. Maybe first of all, we can skip this one. We will come back and compute it. Then we will get what? We will get the total equity. We will get the total equity. And I hope you can also be able to record your total in a fund. These are some of the items you don't have to compute in an exam. They'll consume a lot of your time and you end up maybe getting that figure wrong. So, but we will come back and compute. We will compute that. Then down here, after getting this, we also come and we compute something called the non-controlling interest. I'll be able to explain what is this in the process of computing that, but we will compute this as the last two items. Then from there, we need to proceed and we record liabilities. I think for liabilities, we have the current liabilities, but in this case, there is something we are going to introduce. We are going to introduce non-current liabilities. I hope you can be able to remember this deferred consideration. These are consideration to be paid by the parent company in future. So that deferred consideration will be recognized here as a non-current liability. And basically, I've said the value for deferred consideration at the end of the day is this one. we have amortized that. So this amount plus the interest for that year, which will give us what? Which will give us 2110. And then finally, we have the current liabilities. Current liabilities, we take those of the parent 3,000 plus 19, those of the subsidiary. And then you have now to recall that these include payables. Payables, we have amount of intercompany debt, which should be adjusted from the payables, this one, 500. So that one should be deducted here, 500. So give me the final figure. Give me the final figure here. The final figure for payables, for current liabilities. For current liabilities, I'm told is what? 44. Yes, 44. 44. So what I want us to do, I want us to compute these two items here very fast. Very, very fast. We should be able to do that in the next 10 minutes. We should be done. Yes, so we can start by computing what? Let's start by computing the group retained earnings. But basically, I've said, if, for example, you're doing that question in an exam, and basically you leave it like that, you should be able to get all marks. You should be able to get all the marks. So let's start by computing this one. The group retained earnings at the end of the year, that is carried down. That is carried down. That is carried down. So how do we compute this one? How do we compute this? So the first thing maybe you need to remember is the formula. How do we compute this? So this one is computed by taking the 100% of the parent company retained earnings plus for this company here, that is paper, we should take 80% of a post-acquisition retained earnings plus 50% of sisters. I've said 80% of paper, paper limited post-acquisition retained earnings plus 50% of sisters limited post-acquisition retained earnings. Yes. That's basically how we compute that. So what basically we should do is to have 3 columns for our companies here, starting with the parent, which is LOC, the subsidiary paper, and the joint venture sisters. And basically in this case, we will take what? We will take the retained earnings as given in the statement of financial position. So we go to the statement of financial position, we take the retained earnings balance carried down as given in the statement of financial position. So can you go to the statement of financial position of these 3 companies, specifically at the equity? At the equity, we're given the retained earnings of ROC, that 380. For paper, it is given as what? 1,800, and for sisters is given as what? Is given as 12. So the first thing we need to do for these 2 companies, we are interested with the post-acquisition. So what we need to do for these 2 companies is to less the pre-acquisition. What? Acquisition. That does not apply to the parent. It only applies to these 2 companies. Yes. And I think for this, what we will do, for this company, I think for paper, we computed the pre-acquisition. The pre-acquisition retained earnings, which we have used in the computation of goodwill. How much was it? Give me that figure. We have computed the pre-acquisition retained earnings for paper. That is something you have already computed. Who can give me that figure? that retained earnings in tulitumia kucompute goodwill ya paper. Was it 1280? The one at the start? Yes. So this one we said is pre-acquisition. Is that the case? So pre-acquisition ya hii ni 1280. So we will less it there such that we shall be left with the post-acquisition. And then what about the scissors? Scissors, when was it acquired? I hope you can remember when scissors was acquired. Scissors was acquired 6 months to the end of the year here. Was acquired 6 months to the end of the year, 6 months to the end of the year. Basically, for scissors, we need to have, first of all, its retained earnings at the end. Its retained earnings at the end for scissors is 12, the value which we have here. Let's be together here. And then we also need to have the profit for scissors for the year. That one, we get it from the income statement. From the income statement, the profit for the year for scissors is 640. Yes. So can we first of all get the retained earnings here at the start of the year? So to get the retained earnings at the start, we will take this minus this, we get this. This minus this, we get this, which will give us what? Which will give us 560. So can we be able to get the retained earnings of scissors on this date of it was acquired? Just like how we computed this is quite simple. To touch this one at the start 560, and then we take for the whole year, which is 640. And here, because we have 6 months, we get half of this. We multiply that with 6 all over 12. So we take 560 plus 320 plus 320 plus 320. That will give us what? That will give us, I hope you can see what I've done. I've taken the retained earnings of scissors at the start, which you have said is this, minus this, which will give us 560. And then for me to compute its retained earnings on the date of acquisition, which is pre, I've taken the retained earnings at the start plus the profit for the year for this 6 months, just like what we did for the subsidiary. So, and I'm told that will give us 880. So now we get the post. Basically, I've said this does not apply to the parent. So what do we get here? Because of time and track value, what do we get here? We get what? 520. What about this one? We get 320. We get 320. Yes, 320. Then before now we apply these percentages, because this one we should take 100%, this one 80%, this one 50%. There are some of the retained earnings here we need to be adjusted. As per the workings which you have done here, number one, we have this depreciation other charge, which we said should be deducted from the retained earnings of this company. So we have depreciation other charge to be deducted from the retained earnings of paper, which is 70 there. So this and this will not affect that, but we have this and it is profit, this one. We say this one will also be deducted from the retained earnings still of paper. So we have an it is profit that will also be deducted from the retained earnings of paper, 50, like that. Do we have any other adjustment? I can't see any other. So we need to get the final figures, that is 380, this one 2400, this is 320. And then we get the group share of this. The group share. We apply now these percentages. This one for the parent, we take 100. For paper, we take 80. And for this company that is the sisters, we take 50. We take 50%. 50%. So this will be 160. This will be 320. This one will be 3380. And then we add these two. We add those three values. That will give us the group retained earnings. The group retained earnings. I'm told that will give us 38 what? 60. basically you can see how the computation for this is quite demanding. And that's why I'm saying, for example, if you're doing this question in an exam, I will not advise you to do this. I will not advise you to compute this. Yes. So maybe first of all, you can get the total equity before computing NCI. So this will be 55 plus 3860, which basically give us 9360. Finally, we compute the NCI. So the NCI is what? We'll talk about the NCI basically. This refers to the amount of money which is invested by the minority shareholders in the subsidiary. The capital invested by the minority shareholders in the subsidiary. Amount invested by the minority shareholders in the subsidiary. How do we compute the NCI at the year end? To be recognized there as a component of equity. Now to compute this, very simple. We take the NCI at fair value. The NCI at fair value, which is basically given in note 2. The NCI at fair value in note 2. How much is the NCI at fair value? The NCI at fair value in note 2 is what? Is 860. 860. I hope you can see that. And then to this, what we add here is something called the NCI share. NCI share law, the post that is of the NCI share of adjusted post acquisition retained earnings in the subsidiary company. So the NCI share of the post, that is the NCI share of the adjusted post acquisition retained earnings in the subsidiary. So where do we have this figure? The adjusted post acquisition retained earnings of the subsidiary. So that is basically the figure which we have here. This is the adjusted, this is the adjusted post acquisition retained earnings of the subsidiary, which is how much? 400 million. So we get the NCI share of that. The NCI share of this will be 20%. Will be 20%. 20% of that will give us what? That will give us what? That will give us what? Is it 80? Yes, it will give us 80. And then now to this, in case, for example, we had an impairment loss, the goodwill on acquisition was impaired. What we less here is the NCI share of impairment what? Loss. Was the goodwill impaired? No. No item to be deducted there. So we add these two values and they give us 9 what? 940. So the NCI fair value here is basically 940. But basically I'm saying although these are some of the tips we will be able to discuss in the during our revision. So whenever you're doing that question in an exam, I will not advise you to compute this and this, because even without computing those two items, you'll have scored all the marks. Is our statement of financial position or balancing? It is not balancing. That is what I'm told. What is the difference? What have you omitted? Ten. Or 10 bob. $10 bob. 10 bob is, where do we have that? Where do we have that 10 bob? Yes, I think it is. That one should be. Is it interest? The interest on deferred consideration. No, that one is captured there. That one is captured there. That one is captured there. So you're saying the difference is What is the difference? Is the difference is it 110? 110? Yes, I know where that one should be captured. That one basically should be deducted from the retained earnings of the parent here. Because that is an interest or is basically an expense which the parent company was supposed to have accounted for. But if you check on the income statement, the parent company had not accounted for the interest on this. So that one should also be adjusted here. The interest on deferred consideration, it should be deducted from the retained earnings of the parent. Deduct that here. Deduct that here. It was supposed to be accounted for as an expense by the parent, but the parent company had not accounted for that in the income statement. Was it accounted for by the parent company? No. So that's why it should be deducted there. 33, 80 minus 110. So now this one should be 32, 70. And the retained earnings should be 37.50. Yes, it should now balance. It should now balance. It should now balance. Is it not balancing? Yes, it should balance. So I think that is what you have forgotten here, because remember, these are an expense which the parent company was supposed to have accounted for. The parent company needed to recognize this as an expense, and that's why you can see in the income statement, the parent company didn't have a finance cost that was supposed to be captured here, and therefore even the profit which you have taken into account here, that was supposed to have been deducted, and because it was not deducted, that's why we're deducting it here. Sasa, yes. So basically, this is what was required as far as that question is concerned. And I'm saying this is one of the easiest questions which has ever been tested in advanced financial reporting in relation to the group account. In relation to the group what? Account. And there is a question which I'll give you there as an assignment. You attempt it. Because now what I want us to do once we meet in our next class, we are looking now on special cases in group accounts. We will start by looking on the aspect of piecemeal acquisition. We do a question, just a small discussion, and then we do a question. In our next class, that is what we will do. That is on Tuesday. Then on Wednesday, we will be able to look on how we account for the disposal of interest. And then on Saturday, we do foreign subsidiaries. So basically, we should be done with this next week. What we will be remaining with is the group cash flow. Is the group what? Cash flow. So because we have those three concepts which are remaining: piecemeal acquisition, the disposal of interest, and the foreign subsidiary. We will be able to take one class each, but basically we will be able to come back and look on this during our revision. So the question I want you to attempt is the question for December. The question for December 2022, which basically is question number 3. Question number 3. I want you to attempt this one. Maybe during our revision, we will be able to look on it. We will be able to look on that. We will be able to look on this. We will be able to look on this. Remember, what we said is that if everything goes on well, we should be done at least with this by next week, our first class. And then from there, I think what will be remaining is maybe the theories and maybe like the financial statements of the insurance company. Right now, we can say that we are almost like over 85% done with the syllabus. So I'm hoping that if everything goes on well, we should be done with this by next week, but one on Tuesday. On what Tuesday? So Let's stop at that point for today. You have a nice weekend and make sure you attempt that particular question. In case you come across any challenge, you can maybe get some assistance from me. Equally, if you're able to attempt the question, you can send it to me. I'll be able to check on it and give you the feedback. Sasa, yes, we stop at that point. Have a nice weekend. See you next week on Tuesday. Yes, so today I want us to continue with our discussion still at the management accounting by looking on how we prepare budget. And we're going to start by looking on how we prepare the first budget, which is a cash budget. Cash budget is very, very simple because we know that a cash budget is basically prepared to show the expected receipt of money, to show the money which is expected to be received by the company, and also to show the expected expenses to be paid. In other terms, we prepare a cash budget to show the cash inflows, the amount of cash which will flow into the business, and also the cash outflow, the cash which will flow out of what? Of the business. So, and I think I'll be able to remind you in terms of the format for doing that. But equally, I hope you can be able to recall something you did in relation to the cash what budget. So therefore, I want us to just go straight to a question, but maybe I'll be able to share something more, something small in relation to this, maybe just to remind you what is a cash budget and maybe how do we prepare the same. But let's just go straight to the question because I think by preparing, doing a question on cash budget, basically we'll be able to recall how do we prepare these cash budget. Now we have this question which was examined in December of 2024. It was basically question number 23. Remember, section 2, we said it has 3 questions. Question 21 coming from FR, question 22 coming from FM, and question 23 coming from MA. So this was the question number 23, and basically it was a question on what? On the cash budget. Now, before you prepare this cash budget, I want us to go through this information which we have here, and we see what we are told. We see what we are told. So we are told that Elimu Busara Foundation runs a group of secondary schools in the country. Among their schools is Masomo Bora High School. The schools are funded by the school fees and partially sponsored by capitation from the government and donation from alumni and well-wishers. So Masomo Bora High School is preparing the budget for the year 2025 with the 3 terms commencing January, May, and September. So it is important for you to note those dates when each of the term is commencing. The first term commencing in January, the other one in May, the other one in what? September. And then you're told the following details related to the budget preparation. Number 1, you're told the school estimate it will have 120 students in Form 1, 110 students in Form 2, 100 students in Form 3, and 100 students in Form 4. The Form 1 will report in February of 2025. So Form 1 will not report at the start of first term. I hope you can recall first term start on January. So Form 1 will report in Feb. And then you're told the following is the fees structure that is payable by the parent per term. So we're given the fees which is payable by the parent or having student in Form 1. Form 1, there are some details I'll be able to do away with here. Basically, these are details which I added. They should not be part of the question. So the fees payable per term by Form 1 parent is 33,500, Form 2 36,500, Form 3 43,500, and Form 4 45,000. It is also important to note that those are fees per term, fees per term, and also per parent. Number 2, we are told parents are usually required to pay 60% of the fees when the school open and the balance at the beginning of the next month We are told Form 1 pay 60% when they report in Feb and 40% in March. Number 3, we are told the school receive capitation of shilling 16,000 per student per term, which is received at the beginning of the term. So basically, capitation is the funding received from the high school or received from the schools from the government. So then number 4, we are told on average the school receives donation of 2.5 million per month, but this reduces to 60% when the school is closed. Number 5, we are told the school has a small farm which it generates harvested produce. And then you're told it is estimated that the produce generates shillings 200,000 per month. Number 6, in addition, the school hires out the bus every weekend for events earning shillings 60,000 per month, except in December when the bus driver is on leave. Number 7, you're told the school pays an average salary and wages of 6.2 million per month, even when the students have closed. Number 8, we are told the school spent on average 550,000 on general consumables, which reduces to 60% when the school is closed. Number 9, the school buy new textbook and also replaces the old ones at the beginning of every term for shillings 650,000. Number 10, you're told the school provide meals to staff and students at an average cost of 1.5 million per month. And then you're told this is catered for in the school fees and capitation. The amount reduces to 40% when the school is closed. And then you're told number 11, electricity and water bills averages on 50,000 per month and 50,000 when the school is closed. Repair and maintenance also amount to 250,000 per month, and it reduces to 40% when the school is closed. Number 12, we are told the school plan to buy an additional learning and staff equipment worth shillings 1.5 million in January and replace the old furniture at a cost of 2 million in May. The old furniture will be scrapped for shillings 200,000. So being scrapped means that the old furniture will be sold for an amount of how much? For an amount of 200,000. Number 13, you're told the school has a loan for which it will pay the annual installment of 2 million and the interest of 200,000 in what? In December. So, and then you're told number 14, the school estimates it will have a cash balance of 5.5 million on 1st January 2025. What are we required to do here? We are required to prepare a cash budget for the year which ended 31st of December 2025 on monthly basis and also for the whole year. So let me copy this one. Remember, I said once you come across this question, you do this question, you have your solution within the same Excel worksheet. That's what you can see in my case. I've already splitted this Excel worksheet into 2. So here we'll have the question. On this side, I'll have what? The solution. So up here, I'll basically have what? I'll have the solution. I'll have the solution. And basically what we are required to prepare here is what is a cash budget. But I think even before you move to prepare that particular cash budget, I think there are a number of items which you must compute. For example, in this case, you can see the fees to be corrected by this pool. We have not been given the actual figures. So we have to compute that. So therefore, the first thing we need to do here is basically to have some few workings to compute a number of items, especially the fees which is to be corrected. The fees to be corrected both from the parent and also the fees to be received in form of government capitation. So therefore, I will start with the workings here. And I think the first working will be on what? The first working will be on the fees, school fees to be corrected. Let's start by computing the school fees. the school fees to be corrected, or actually to be received from the parent. Remember, in this case, we have the government capitation and the fees which is paid by the parent. I want us first of all to start by computing the school fees which will be corrected, which will be received from who? From the parents. And basically in this case, we're going to compute these school fees to be received from the parent in months, or basically in each month. Because I hope you can be able to record here in note 1, we are told the school estimate it will have 120 students in Form 1, 110 students in Form 2, 100 students in Form 3, 100 students in Form 4, and then you're told Form 1 report in Feb. And then you're told the fees is this is basically the fees which is payable per term. And then you're told the parents usually are required to pay 60% of the fees when the school open. That is basically in January, and then the other one in Feb. So therefore, we're going to compute these particular fees to be corrected or to be received from the parent per month basis, or on monthly what? On monthly basis. So in this case, I'll start from January. I'll start from January, and then I'll have Feb here, all the way up to December. Do I have to repeat all this? Do I have to type all this up to December? No. Once I type the first 2 months, so basically we can highlight the 2 months, and basically we do what? We drag like this. We don't have to type all that. So that will take us up to December like that. Okay. So then in this case, I can also bold this one. I can bold this. Yes. So we need to compute the fees which is to be received from the parent, and we are going to start by computing the fees to be received from the parent, or basically the fees to be corrected from Form 1, and then we do the same. We compute the fees to be corrected from Form 2, up to Form 4, basically, I don't have to keep on typing this. Yes, like that. Form 1 all the way to Form 4. So we need to go back to the information which are given here. And I think to make our work easier, I think we can summarize these students here, because we are told now, note 1, the school estimate to have 120 students in Form 1. So the student here are expected to be 120. The student expected in Form 2 are 110. The student expected in Form 3 are basically 100. The student expected in Form 4, 120 Form 1, 120, 110 Form 2, 100 in Form 3, and also 100 in Form 4, like that. So having those numbers will make our work a little bit easier. Including these school fees, I think we can just have them here. This is the 33,500. This one is 36,500, and then this one is 43,500, and then this one is 45,000, like that. 45,000, like that. 45,000, like that. Okay. So we need now to correct the fees which is to be corrected per month. Remember, we are going to start, in this case, we start with Form 1. Form 1, we report in which month? Form 1, we report in Feb. So no fees to be corrected from Form 1 in January. So the fees to be corrected here will be equal to the student to be enrolled in Form 1, that is 120. I'll basically multiply this with the fees which is payable per our company here, company Y, will invest in shares or debentures issued by company X. So therefore, to this company, that is a financial asset. Is a financial good asset. So therefore, you can see in this particular contract, which is entered into between two companies, company X and company Y, it basically gives rise to a financial asset to this company, equity or financial liability as far as this company is what is concerned. So that's why we are saying a financial instrument is a contract which gives rise to financial asset, one of the company, a financial liability or equity to another word, a company. That's why in our introduction we say the financial instruments are those securities, including shares, including debentures, which are issued by the company. Today's what? A capital. Now, in this topic here, generally, we're going to look on how we do what? How we account for the financial assets, the financial liabilities, and also the classification, because we have different classification of financial assets, different classification of what? Of the financial liabilities. But even before you do that, next I want us to look on something called the recognition of financial instrument. Recognition of financial instrument. What do we mean by recognizing financial instrument? Recognizing, in very simple terms, is basically the process of recording something like an asset or recording something like a liability in the company's books of account. So a question arises here: if this company issues shares or issue debentures, or maybe this company purchase shares or debentures, so when should these companies go ahead and recognize, or in other terms, record those particular shares or debentures in their books of account? According to IFRS 9, this started here, financial instrument, whether issued or basically whether purchased, should be recognized once an entity becomes a party to the contractual relationship. What does that mean? It basically means that once this company has issued these particular shares or debentures, even if our company has not been paid for the shares, has not received cash for the shares or debentures which have been issued, our company has already become a party to that contract simply because it has already issued the shares or debentures. The same case, once this company purchased the shares or debentures issued by this company, even if this company has not paid for those shares or debentures, this company should go ahead and recognize that in its books of account as a financial asset. So therefore, according to IFRS 9, a financial instrument should be recognized in the company's books of account whenever an entity becomes a party to the contractual relationship. Then next, I want us to discuss something to do with the recognition of financial instruments. The recognition basically is the direct opposite of recognizing. The recognition is the direct opposite of what? Recognizing. The recognition of a financial instrument. So by definition, we say to be recognized is to remove a financial instrument from the entity's statement of financial position. It is a process of removing a financial instrument. If, for example, a company had issued debentures, so those debentures may be removed from the balance sheet, may be removed from the statement of financial position, maybe because they have been redeemed. So that process through which financial instruments are removed from the statement of financial position, we refer to that as the recognition. So this is the removal. This is the removal of previously recognized financial instruments from entities statement of financial position. A company had issued debentures, but now those particular debentures have been removed from the statement of financial position. They will no longer be shown there as a liability. That process we refer to it as the recognition. Now, when can the financial instrument be recognized? We have various criteria upon which the financial liabilities can be recognized, of which in this case we are going to look on the recognition criteria for both the financial assets and also the financial liabilities. But even before we look on the criteria here, you have to recall what is a financial asset. A financial asset, basically, I've said that this is a investment in a debt instrument, investment in debt instrument. For example, if today you have some cash in your bank, instead of money staying there, you may decide to invest in government securities. You go to you buy government securities having a value of 1 million, and then you'll be earning some interest. Once they mature, you're given back your money. So that investment in government securities to you is a financial asset. Sasa, yes. So a question then arises: when should the company remove financial asset from its books of accounts? There are two criteria when that may happen. One is when the entity transfers the rewards and the risks associated with the financial asset. When the entity transfers the risks and the rewards associated with the financial asset. What does that mean? And let's assume that we have a company here, company X, and this company has invested, for example, in the ventures of another company. So to this company, we are saying that investment in the ventures is a financial asset. So when should this company, or when can this company remove those financial assets from its statement of financial position? One of the circumstances when this company transfers the risk and reward. So generally, what we know, anytime you have undertaken an investment, anytime you have invested, there are some rewards, there are some risks associated with that particular investment. But when can you transfer those rewards and risks? So to transfer is basically when you sell. So meaning that once this company sells this particular debentures, then we say that the company has transferred the risk and rewards. It is obvious that once you have sold an asset, you cannot continue showing it in your balance sheet because it has already been sold. You have transferred the risk and rewards. They recognize that, remove that asset from your balance sheet. Number two is when the entity's right to receive cash expires. When the entity's right to receive cash has done what? Has expired. So the entity's right to receive cash has expired. So generally what we know is that once you have invested, for example, you have invested in treasury bonds having a life of 2 years, it basically means that you have a right to earn interest from the government for the next 2 years. At the end of the second year, once those treasury bonds mature, you'll be given back the principal amount you invested. So meaning at the end of the second year, your right to receive cash will come to an end simply because those particular treasury bonds have been redeemed. They have matured and the government has done what? Has redeemed them, and you have been given back your principal amount. So if you're a company and basically you had shown that as an asset, you cannot continue then showing that as an asset simply because your right to receive cash has expired. You have earned interest for the next 2 years, and then at the end of the second, you have been given back your principal amount. Then there is no way you will continue showing that as an asset in the statement of financial position. So therefore, the other criteria for recognizing financial asset is when the entity's right to receive cash has expired, maybe because the debt instrument which the company had invested in have matured and they have been redeemed. So in this case, we have those two criteria. Those as the two criteria upon which a financial asset may be recognized. And in this case, we have said it's important for you to understand what is a financial asset. It's basically an investment in shares. It is an investment in debt securities. At a later stage, we are going to look on the various categories, the various ways in terms of how we classify the financial asset. But next, I want us to look on the criteria or the criteria for recognizing a financial liability. Financial liability. What is a financial liability? A financial liability basically here is, we say, is an obligation to pay cash. An obligation to pay cash generally arises whereby a company has issued debt securities. Like assuming we have company X, that company has issued debentures that company has issued both, maybe having a life of 2 years. So that company has an obligation to pay interest for the next 2 years. And once those debentures on both mature, the company must redeem them by paying back the principal amount. So therefore, a financial liability here, this is a financial obligation to pay cash. Financial obligation to pay cash. Cash. And basically, this arises whereby a company has issued some debt instrument. Debt instrument issued by the company is a financial liability. So when should the financial liabilities be recognized or removed from the statement of financial position? Here we have just one criteria, and that is when the entity's when the entity's obligation to pay cash expires. When the entity's obligation to pay cash has done what? Has expired. What does that mean? It basically means that, or assuming you have a company here, company X, this company has issued debentures, and these debentures have a life of 3 years. Having a life of 3 years means that this, or in this case, this company will be required to pay interest at the end of year 1, at the end of year 2, and also at the end of year 3. And then at the end of year 3 here, these particular debentures will be redeemed, and the company will pay back the principal amount. So once the company pay back the principal amount, then we say that the obligation of this company to pay cash will expire at the end of year 3. So it is obvious that because those particular debentures have been redeemed, the company cannot continue showing them in the balance sheet as a liability. They have already been redeemed. So in that case, then we say that those debentures, those financial liabilities have been what? Have been recognized. They have been removed from the entity's statement of financial position because the obligation of the entity to pay cash has done what? Has expired. Expired. Yes. So that, or those are basically the various criteria upon which financial asset and financial liabilities may be recognized. So you may come across a zero question asking about this, whereby you're required to explain the criteria for the recognition of financial assets, and financial liability. So next, I want us to look on something known as the compound financial instrument. So compound financial instrument, these ones are abbreviated as CFI. So what do you mean by compound financial instrument? So these are the financial instruments, things like debentures, things like bonds, which contains both equity and liability component. So therefore, these are financial instruments, which contains both equity. They contain both equity and liability component. They contain both equity and the liability component. Now, what is a good example of this? What is a good example of a compound financial instrument which contains both equity and liability component? Examples of this include the convertible securities. So what do you mean by convertible securities? These are the securities which can be converted, or basically these are security where the holders have the right to convert them into ordinary shares. The holders have the right to convert them into ordinary shares. And actually, good examples of these convertible securities include the convertible debentures, the convertible bonds, maybe the convertible loan stock. And why do we refer to these securities as convertible? Why do we refer to them as convertible? Is because the holders of these securities can be able to convert them into ordinary shares. I hope you can be able to remember in company law. In the topic of the debt instrument, you talked about different types of debentures, and you're told that one type of debenture which may be issued by the company is convertible debentures. These are debentures which you can be able to convert into ordinary shares of the company. So therefore, anytime you come across a debt instrument, like debentures, like bonds, like loan stock, which are convertible, then we say that they are compound financial instruments. They contain both equity and liability component. Now, why do we say that these compound financial instruments or these convertible securities contain equity and liability components? Two reasons. One, the company which issue these securities, one, we say the issuer is basically the company which has issued. The issuer, the company which has issued these convertible securities, has an obligation to pay cash. What does that mean? It basically means that assuming company X has issued convertible debentures, then we are saying that this company has an obligation to pay cash. The cash to be paid by this company is interest and the principal amount. If the holders of these debentures will not convert them into ordinary shares, once they mature, our company will be required to do what? We will be required to redeem them by paying back the principal amount. So the issuer, the company which has issued those debentures, has an obligation to pay cash. This obligation to pay cash to accompany this is a liability. This obligation to pay cash to the company is what? Is a liability. This financial obligation to pay cash is a liability. If you have taken a loan from a bank, basically you have to repay back that loan. To you, that is a liability. If a company has issued debentures, our company has to pay interest, and once the debentures mature, the company has to pay back the principal amount. That is a liability to our company. So that's why we are saying that these convertible debentures, they have liability component. The company which has issued them has to pay cash. Number two, we say that the holders of these compound financial obligation, the holder has a right to convert them, into ordinary shares. So basically, if you hold some convertible debentures, you can be able to convert them into ordinary shares of the company. What does that mean? It basically means that you have a right to receive ordinary shares of the company. Naturally, that right to receive the ordinary shares of the company, that one we refer to it as equity, because equity is whereby you have already bought the shares of the company, or you have the right to buy those shares. You have the right to be issued those shares. We are saying you hold convertible debentures which you can be able to convert into ordinary shares. So that right you have to convert those securities into ordinary shares is called what? Equity. So this why we say that all convertible securities contain equity and liability component. We have said they contain a liability component simply because the company which has issued them has an obligation to pay cash. The cash to be paid here, we have said, will be in form of interest. The cash to be paid here will be in form of interest and the principal amount. Number two, we have said they contain equity components simply because the holder of those convertible securities can convert them into ordinary shares, has the right to convert them into ordinary shares, which basically we are saying is what? Is an equity in itself. Now, this compound financial instrument should be accounted for in accordance with a different standard, not IFRS 9, but they should be accounted for in accordance with International Accounting Standard number 32. This standard, IAS 32, basically requires that anytime a company has issued compound financial instrument, the company should split these two components. The company should split the equity component and the liability component and account for them separately. So therefore, this standard, we say IAS 32 requires an entity to split the two components. to split the two what? The two component. So which are the two components here? The equity component, and number two, the liability component. So those two components must be separated, must be split in other terms, and be accounted for separately. I want us to look on how basically we do that particular split. We do that split, but even before you do that, you can confirm whether we are together up to that point. I hope you are together up to that point. Are we together up to that point? Maureen, Kennedy, Ismail, Wanyama, are we together up to that point? I hope you're getting the video from your end clearly. I hope you're getting, my sound is perfect. My sound is okay from your side? Okay, sawa. Let's continue then. If you're together up to that point, we can proceed. Now, what I've said is that this particular standard, IAS 32, requires that anytime the company has issued securities which are convertible debentures, convertible bonds, convertible on stock, which contains equity and liability component, the company should split the equity and the liability component. How should that split be done? So we have two steps to be followed. The step number one is that the company should compute the liability component. Step one, for us to basically compute the liability component. So in this case, if you can be able to recall, you have said this liability component analysis as a result of the company's obligation to pay cash, which is in form of interest, which is in form of principal amount. Like assuming in this case, a company has issued debentures having a life of 3 years, year 1, year 2, year 3. So a company has issued convertible debentures having a life of 3 years, year 1, year 2, year 3. So in this case, we have said at the end of year 1, at the end of year 2, at the end of year 3, our company will be required will pay the principal amount, and also at the end of year 3, the company will be required to pay. I've said at the end of year 1, at the end of year 2, at the end of year 3, the company will be required to pay the annual interest. And then once they mature, that is at the end of year 3, the company will be required to pay back the principal amount. But in this case, here we assume that the holders of this particular convertible debentures will not convert them into ordinary shares. Shares. So if the holders will not convert them into ordinary shares, for the next 3 years, the company must pay interest on annual basis, and at the end of the third year, the company must do what? Must redeem them by paying back the principal amount. So how do we therefore compute the liability component? To compute the liability component, which has to be computed on the date of the issue here, we compute that by discounting all this. To discount basically entails computing the present value. So we get the present value of the interest to be paid annually and the present value of the principal amount. So meaning that the liability component, and basically this liability component is computed on the date of the issue. Or in other terms, this split should be done on the date of the issue. The date they were issued, if they were issued 1st January 2023, that is when we split the two components. Sasa? Yes. So to compute this liability component, the liability component here is equal to the present value of the annual interest So basically, I hope you know how to discount this. Remember, these are annuities, this and this, because these are similar cash flows. So these are annuities. So you know how to discount that from financial management. And then to this, we add the present value of the principal amount. The principal amount is this amount, which is payable upon redemption. So basically, we do what? We add these two figures: present value of annual interest plus the present value of the principal amount. That is how we compute the liability component on the date of the issue. After computing the liability component, step number 2, we proceed and we compute the equity component. Step 2, compute the equity component. The equity component. So how do we compute the equity component? To compute this equity component, we take the total proceeds. The total proceeds. So basically, in this case, when we talk about the total proceeds, this refers to the amount of money which was received by the company after issuing these convertible debentures. So how much amount was received? This, in other terms, is known as amount received. The amount received, or in other terms, the total proceeds. So total proceeds, and then to this we less the liability component. We less the liability component, which you have computed in step number 1, which you have computed here in step 1, which you have computed there in step 1. I hope you can be able to see down there. Yes, which you have computed in step 1. Step number 1. Yes, so computed in step number 1. So after deducting that, we get the difference here. We get the difference here, and this difference is the equity component. Is the equity component. It's also important for me to mention that the value for this equity component, basically this one remains constant. The value for equity component, which has been computed on the date of the issue, will remain the same in year 1, year 2, year 3. So that remains constant. The value for equity component does not change. But this value for the liability component, which I've computed in step 1, remember this represents what the company will pay in year 1, year 2, year 3, year 4. So take into account this like a loan. If, for example, today you go to a bank, you take a loan for 5 years. So that means that for the next 5 years, you have an obligation to pay back that loan. So, and basically what that means that generally you should prepare something, or a bank prepare something called a loan amortization schedule to gradually write off that loan, such that at the end of the 5th year, the value for the loan will be 0. The same case, this liability component, we amortize it. This liability component, we do what? We amortize it. To amortize a liability or even amortizing an asset, this is the process of gradually writing off. Gradually writing off an asset, gradually writing off a liability over a given period of time. Over a given period of time. So therefore, these are basically the 2 steps which we follow to do what? To split the equity component and the liability component. The equity component and the liability component, equity component and the liability component of a compound financial instrument, instrument. I think with that particular knowledge, we can go to the past papers. I want us to do a question. from the past papers. And maybe for those who are coming from CPA intermediate level, there was a question which was examined on this in FRA, and maybe if you are in my class, automatically we did that question. So I want us to do another question, basically from AFR. So someone is asking here, how do we get the amount received? Total proceeds. Total proceeds always will be told how the debentures. For example, in this case, you can be told the company issued debentures having a par value of 100 million, at a discount of 10%. In this case, to compute the amount received is quite simple. The debentures issued had a value of 100 million, but you can see they were issued at a discount of 10. Did our company receive the full amount of 100 million? Yes or no? Did the company receive an amount of 100 million? No. The amount received in this case would be 90% of 100 million. So the amount received in this case is computed always based on the information which is provided. So the examiner will give you information which basically will assist you in terms of computing the amount which was received. So I want someone to share the past papers in the class WhatsApp group. Someone to share the past papers in the class WhatsApp group so that I can tell you the question I want us to do. I can tell you the question I want us to do. The question on compound financial instruments. Yes, I hope those past papers have been shared there in the class WhatsApp group. Yes, I can see they have been shared there by Ismail. So the question I want us to do was, I think, tested some time back, not too back. Let me see. Yes, there was a question from this topic, though it is not in relation to compound financial instrument. This was just a small question. I think it was in the sitting of 2021 there. A question for Naivasha Company Limited. Just a small question. I'm trying to retrieve that question here. Yes, so it is a question from May 2021. May of 2021. And this is question number 4B. Question number 4B. Question 4B. So let's go to this particular question here. 4B. May 2021. Question 4B. So once you get the question, just confirm that you have the question with you. So once you get the question, just confirm. Okay, confirmed by Otunga there. Yes, Ismail Aither, Mase has confirmed. Maureen, are you there? Diana, you have the question with you. Eddie, Faith, Patrice, Samuel, you have the question with you. Do you have the question with you? Yes. Yes. So what are we told here? What are we told? Just a small question, but you can see the question had 6 marks. So the question reads, Naivasha Limited issued 500 convertible notes on 1st January 2018 at par. They were issued at par. Each raw note is redeemable in 3 years' time. In 3 years' time at its par value of shillings 2,000 per note. Alternatively, each note can be converted at the maturity date on 1st January 2021 into 125 shillings 10 ordinary shares. And then in this case, we are told that their own notes pay interest annually in arrears at a coupon interest rate based on the nominal value of 6%. The prevailing market interest rate for 3 years raw notes without conversion rate is 9%. So what are we required to do here? We are required to prepare the extract of financial statements of Naivasha Limited for each of the year ended 31st of December 2018, 2019, and 2020. The marks allocated here were six. Now, what is important first of all here? So the first thing, or basically the first important thing to do here is basically to see that these loan stock or these loan notes which were issued by our company, they are convertible. They are what? Convertible, because we are told the company which is called Naivasha Limited issued convertible loan notes. So anytime you see the word convertible, what you need to remember very fast is that this is a compound financial instrument. This is what? A CFI. Because I've said all convertible securities, all convertible debt instruments, they contain both equity and liability components. Therefore, on the date they were issued, what our company was supposed to do here is to split the equity component and the liability component. So therefore, maybe here we can say that these convertible loan notes issued by Naivasha Limited. Naivasha Limited is a compound financial instrument. So having known that, then you need to record what you have said. We have said, according to IS 32, on the date of the issue, the company should split the equity component and the liability component. The company should split the equity component and the liability component. Equally here, we have discussed the two steps to be followed, basically in computation of the same. So what I want us to do is we basically go straight to splitting the equity and liability component. And we are going to start by computing the liability component. Step number one, we have said, is to compute the liability component. And actually this one is always computed on the date of the issue. So when were these compound financial instruments issued? They were issued on 1st of January 2018. 1st January 2018. That's when we should do the split. So how do we compute this liability component? The liability component you have said is equal to the present value of the annual interest, present value of the annual interest, plus the present value of the principal amount. So if you can be able to remember that, then it becomes quite simple. So we need to first of all compute how much interest will be paid by a company on annual basis, how much amount will be paid on redemption, because you have said the principal amount is the amount to be paid once this convertible loan stock matures and they are redeemed. So first of all, to compute this one, to compute the annual interest, or basically in other terms, the interest to be paid annually, the interest per annum. How do we compute this one? This formula is very important. You must recall this. This one is computed by taking the coupon rate. The coupon rate times the par value. The par value is also known as the nominal value. It is also known as the face value. The face value of the compound financial instrument. That formula, very, very important for computing the interest to be paid on an annual basis. The coupon rate times the par, the nominal or the face value of this compound financial what? Instrument. Remember, compound financial instrument are the 8% roll notes. Now, equally, if you check on this, the information which are given in this particular question, the information given in this question, you will see that we have two interests. Where do we have the first interest? The first interest is given, I think, in which paragraph? I think both of them are given in paragraph 2. Yes, can we go back to paragraph 2? In paragraph 2, we are told the loan notes pay interest annually in arrears at the coupon interest rate of 6%. So in our case, we already given the coupon interest rate. The coupon interest rate, which is 6%. But in most of the cases, the examiner will not tell you which interest rate is coupon rate. But if you're given something like this, you're given 10% convertible debentures. This particular interest, which comes before the name of the compound financial instrument, this is what you refer as the coupon rate. The coupon what? Rate. Yes, but in our case, we are told the coupon rate is 6%. So we multiply that with the par nominal or the face value of the CFI. CFI are the convertible loan stock. Now that information is given in paragraph 1. Can we go back to paragraph 1? In paragraph 1, you're told Naivasha Limited issued 500 convertible loan stock. 500 convertible loan stock. This is the number. The convertible notes issued were 500. And then you're told they were issued on 1st January 2018 at par. And then you're told each loan note is redeemable in 3 years' time at its par value of 2,000. So the par value of each loan note is how much? Is 2,000. So therefore, we need to multiply this coupon rate because we already have the coupon rate times the par value of the convertible notes. So we are told the convertible notes which were issued by the company, they were 500. But remember, this is just the number. We need to get the par value, the total par value of this. So what does that mean? It basically means that we have to multiply this with the par value of each, because we are told the par value of per row note, the par value per row note is 2,000. So meaning that the total par value of these row notes which were issued will be 500 times what? Times 2,000. So how much interest will be paid by our company on annual basis? On annual basis. So give me the final figure here. The interest to be paid by our company on annual basis would be how much? Will be how much? So which should be 6% of 500 times 2,000. Yes, I'm given a figure for what? Yes, I'm given a figure of 60,000. I'm given a figure for 60,000. So 60,000. So this is the interest which will be paid by our company per annum. And from the information which we are given here, this interest will be paid for the next how many years? Assuming these convertible notes will not be converted into ordinary shares. If they will not be converted into ordinary shares, this interest will be paid for the next how many years? This interest will be paid for the next how many years? Yes, automatically this one will be paid for the next 3 years, because we are told that this particular row note will be redeemed after 3 years. So if they will not be converted into ordinary shares, the company will have to redeem them at the end of the 3rd year. Yes, so therefore this means that this interest, which is annual, will be paid in year 1, year 2, year 3. Also, we are told, I think in which paragraph? In paragraph 2, we are told this interest is payable in arrears. Payable in arrears means that it is payable at the end of each year. So the company will pay 60,000 at the end of year 1, at the end of year 2, at the end of year 3. So having that, then we need to determine this one, the principal amount. So that then we proceed and discount those two items and we add them. So what is the principal amount? Remember, the principal amount is the amount to be paid on redemption. Amount payable on redemption. Amount payable on what? On the redemption. So the amount to be paid on redemption This one is always equal to the par value. If you have invested 2 million in treasury bonds, once they mature, you should be given back your 2 million. Sasa? Yes, so they're redeemable at par value unless otherwise stated. Unless otherwise stated. So there are some questions you may come across, and you're told that this compound financial instrument will be redeemed maybe at a premium of 10,000. So if they will be redeemed at a premium of 10,000, you take the par value, like in this case, the par value will be $1 million plus now the premium. Plus the premium. That is the amount to be paid on redemption. But if the question is cited, the amount to be given back on principal on the redemption should be equal to the par. Although in this question we are given that information. Paragraph 1. Paragraph 1, sentence 2, we are told each loan note is redeemable in 3 years' time. In 3 years' time at its par value. So the amount to be paid on redemption is the par value. So the par value in our case we know is equal to 2,000 per loan note, this one, and then times the total number of loan notes which were issued. So this should give us $1 million. $1 million. So the amount to be paid on redemption will be how much? Will be $1 million. So what we need to do now, because we have the annual interest, we have the principal amount, we just need to discount them. So there are so many, there are a number of approaches we can be able to use to discount this. Let me use an easier one, whereby we are going to have years, year 1, year 2, year 3. Because we know that in year 1, year 2, year 3, the company will pay this. And then also at the end of year 3, the company will pay how much? 1 million. So, and then here we can have like what? We can just refer to this as cash flows, the amount to be paid by our company. So in year 1, our company will pay 60 million, the annual interest. Because we have said this interest, we have said it will be paid in year 1, year 2, year 3. 60 million, 60,000, 60,000, 60,000. And then at the end of year 3 here, once they mature, the company will also pay back the principal amount. That is what we need to know. The amount to be paid at the end of year 1, 60, at the end of year 3, 60 plus $1 million. Yes, I'm saying we refer to those as cash flows. So then in year 3, we are saying the amount to be paid here will be $1 million plus 60,000. Plus 60,000. So what do we need to do? We need to discount this. So to discount this, we need to multiply this with something called the present value interest factor. Which rate are we going to use here? The rate we are going to use is something called the effective interest rate. If you check on that question, we also given another rate other than this, the coupon rate of 6%. In paragraph 2, we are told paragraph 2, the last sentence, the prevailing market interest rate for 3 years loan notes without conversion option is 9%. So that 9% is the one which we use for discounting here. So we multiply this with the present value interest factor at the rate of 9%. This one should be 9%. This one should be 9%. So how do we compute these values? Mostly in financial reporting, you not be given those present value interest factors tables. So you must remember the formula. So the formula for this is 1 plus R raised to power negative n. 1 plus R raised to power negative n. For example, in the first year here, our present value interest factor will be equal to 1. Remember, our R is 9%, 1.09 raised to power negative 1. Our n is this n here. In year 2, 1.09 raised to power negative 2. In year 3, 1.09 raised to power negative 3. Raised to power negative 3. So in year 1, I hope that is the value which I'm given, 0.9174. What about year 2? Year 2, this is how we computed 1.09 raised to power negative 2. Raised to power negative 2, raised to power negative 2, raised to power negative 2, that is 0.8417. Yes, you give me that figure to the nearest 4 decimal places. And the last one I'm given Diana here, 0.7722. Yes, having that, then we need to proceed and we compute the present values. The present values would be whatever you have here times the present value interest factor. So what are we going to have for the first year? The first year, 60,000 times 0.9174, 55,044. What about year 2? 60,000 times 0.8417, which will give us 502. Year 3, 1,060,000 times 0.7722. I'm given by Eddie here, 818. Huh? Which figure is correct? The figure from Eddie, the figure from Diana? Yes, should be 818, 532. 532. Then what we need to do basically is now we add this. Remember what we are computing here. What are we computing? We are computing the liability component. The liability component we are saying is the present value of the annual interest. The annual interest is 60, 60, 60. That is the annual interest plus the present value of the principal amount. Principal amount 1 million, you have said. This one will be paid at the end of year 3. So let's compute this liability component. This liability component on the date of the issue, which is this date here, 1st January 2018. What are you getting as the total? You add all this. You add those figures. You give me the total. 924. 078. 078. That is the figure I'm getting from Mercy here. I'm also getting the same from Diana. So what we have there, therefore, is the liability component. So having the liability components, then what do we need to do? Step number 2, because we are done with step 1. Step number 2, we need to proceed and we do what? We compute the equity component. Equity component. Remember, basically, this part of the workings, we have not yet answered our question. If you take on what the examiner was requiring, we do what? We prepare financial statement extract. So will the approach in liability, in computing the liability component, be different if interest is paid at the beginning of the interest? Yes, it would be different, but practically, is it possible for interest to be paid at the start? No, profit is payable at the end because you have invested. The company can only pay you interest based on the profit. Based on the profit. Though there are those particular short-term government securities, treasury bills, the interest is payable in advance. Yes, for the short term. But I think this long term, the interest is payable at the end. It is payable at the end. Yes. So let's move and we compute the equity component. Equity component will also be computed on this date, the date of the issue, 1st January 2018. So how do we compute this one? So remember, I've given you the formula, the total proceeds, the amount received, minus the liability component, which we computed in step 1. The liability component computed in step 1 is what we have here. 924,078. So we need to determine how much amount was received. This convertible notes, how are they issued by the company? If you go back to the information which are given in this particular question, specifically in paragraph 1, you're told Naivasha Limited issued 500 convertible notes on 1st January 2018 at par. They were issued at par. They were issued at par. So the amount which was received, the amount received here will be equal to 500. And basically, we know the par value for each is 2,000. So the amount received was 1 million. This is the amount received by the company, 1 million. So we take 1 million, the amount received, minus the liability component. Whatever you get here, this one is known as the equity component. The equity component still on 1st January 2018. So what will be the equity component on the date of the issue? The equity component, the difference between 1 million and 924,078. What are you getting here? 229. 75 what? 75,922. 75,922. Yes, so that is the equity component. If you can be able to recall, we said the value for this equity component will not change in year 1, year 2, year 3. That value does not change. But now, this one, which basically is the liability component, this one we have said we must do what? This one we have to amortize it. We have to do what? This one we have to amortize it. This one must be amortized. This one must be what? Amortized. This one has to be amortized. So how do we amortize a liability in this case? From what you did in financial reporting, how do we amortize this? How do we amortize our own? How do we amortize something like a risk liability? What do we have to prepare here? We prepare something called what? Even when amortizing our own, you prepare something called the amortization schedule. The amortization schedule. So we need to prepare amortization schedule because we have not yet answered our question. If that question you leave it at hand, you'll not be able to score the marks. So the question was requiring what? We prepare financial statements extract. We basically show what the company was supposed to account for in the income statement for 3 years and what the company was supposed to account for in the statement of financial position for 3 years. For us to be able to do that, we must first of all amortize this because there are a number of things we are going to compute from that amortization schedule, which the company was supposed to account for, both in the income statement and the statement of financial position. So what I want us to do, I want us to amortize this liability here. We amortize the liability. And basically to amortize this, we have to prepare something called the amortization schedule. So to some extent, it's almost the same with their own amortization schedule because this is now what we want to gradually write off, such that at the end of year 3, it should be 0. So here we have various columns. The first column will be for the years. So we may decide to use year 1, year 2, year 3, year 4, but basically we know that the first year started on this date, 1st January 2018. So it means that the first year will end 31st of December 2018, the second year 31st of December 2019, the other year 31st of December 2020. So what do we want to amortize? This one, the liability. So the first column here will be for the liability at the start, and take into account the interest is payable in arrears. The interest is payable in arrears. The next column here should be for the interest. And actually this interest, always we computed based on the we computed based on the effective interest rate, the market interest rate. If you can be able to recall our effective interest rate, the rate we have used for discounting was 9%. That is, we compute this interest based on this market interest rate, not the coupon rate, the market interest rate. And then here we have the cash paid, and then we will have the last column here, which is the liability at the end of the year. Remember, this is just like Karun. This is just like Karun. How do you compute the loan balance at the end of the year? To compute the loan balance at the end of the year is very simple. You take the loan balance at the start, you add the interest, and then you less the installment you paid. You'll be able to get the loan balance at the end. So that loan balance at the end of year 1 will become the loan balance at the start of year 2. Compute interest, deduct the cash which was paid, you compute this one. And actually computing the loan balance at the end, you take the loan balance at the start plus interest minus cash paid. Minus cash paid minus cash paid. Yes, so in this case, here we don't talk of installment. This cash here is the same with installment. Is the same with installment. But equally in this case, if you can be able to remember in FM, financial management, you compute the installment which is paid, and that installment, I think you split it, you go ahead and split it into two. The principal amount and the interest. Is that the case? That's what you do. Here we don't have to do that. We don't have to split the installment paid in form of interest, in form of principal amount. Yes. So the liability at the start of the year, because what we start here should be the liability at the start of year 1, is what we have computed here. That is the amount we want to amortize. 924,078. So that is what we want to amortize up to the end of year 3. At the end of year 3 should be 0. So then we compute the interest. The interest should be 9% of this, 9% of the liability at the start. So that will be an amount of how much? That will be an amount of how much? An amount of how much? An amount of how much? Amount of how much? 80? Is it 83, 87? Are you getting 83 or 87? I'm getting different figures there from Diana, from yes, 80. What are you getting here, Patrice, somewhere? No, but which figure are you getting here? 83, 167. 83, 167, 167. I wanted to see whether we are together. Can someone tell me how much cash was paid by our company in year 1? Nataka nione kama tuko pamoja. Our company here, this company which had issued these 6%, is it 6%? 6% convertible loan notes. How much cash did it pay to the holders of those convertible loan notes? How much cash was paid? How much cash was paid? I see whether we are following what we are doing here. I see whether we are together. The cash paid by our company is what we have here. These are the cash paid by our company, year 1, year 2, year 3. Yes. So the cash paid here was 60. So how do we compute the liability at the end of the year? Remember, I've said it's just like a loan. So this is the loan balance at the start. This is the interest charged during that year. This is the cash paid. To compute the loan balance at the end, we take the loan balance at the start. We add the interest for that year. We minus whatever was paid. So therefore, this one will be equal to this plus this minus cash paid. The amount to be deducted, we put it inside the bracket. Give me the liability at the end of that year. Yes, what are you getting? Gordon, it cannot be 231. It can't be 231. That one automatically is wrong. It should be around 900 and something. 940, 947, 47 to 45, 245. So that will be the opening balance in the following year. 947, 245. And then we compute interest here as 9%. We compute interest here as 9%. Yes, what are you getting? The interest, 9% of this, 85, 252. 85, 252. The cash paid also is 60. So give me the liability at the end of year 2. The liability at the end of year 2. Yes, we're getting the liability at the end of year 2. The liability at the end of year 2, 972, 497. 497, that will be the opening balance now here. 972, 497. So the interest, which will be 9% of this, 9% of this, 9%, 87, 524, 524. Now we know at the end of year 3, the company is supposed to redeem them. The company is supposed to redeem them. So we are saying to compute this one, liability. We are saying this just like a loan. This was your own at the start. This is the interest you are charged, but you paid this. You paid this. How do you compute the loan balance at the end? You take the loan balance at the start plus interest minus this. So this one is computed by taking A plus B minus C. This loan balance plus interest minus cash paid. Sasa, yes, that's how we compute that one. How we compute that one. I hope that is understood now. Now, here we know the cash which was paid was 1,060,000. But if you check on the question here, when was the principal amount paid? The principal amount. Are we given the date when the principal amount was paid? The 1 million. When was 1 million payable? Because in most of the cases will be told it will not be paid exactly on 31st of December 2020, but you can be told it will be paid on 1st January of 2021. I think that's what we were told. This 1 million, when will the redemption take place? Yes, the redemption, this 1 million will not be paid at the end of this year, but will be paid the following year, the following day actually. So therefore, in preparing our amortization schedule, what we put here is 60, because at the end of the year, will the company pay 1,060,000? No, the company will only pay interest. And basically it means that once you prepare this, even without computing this, here you should be left with 1 million. You should be left with 1 million, and this 1 million will be paid on 1st January of 2021. That is when it will be paid. So therefore, it was not paid here. That's why we are not including 1 million. So, but if the question is silent regarding when this amount will be paid, regarding when this debt instrument will be redeemed, then you would have included 1,060,000. Are we together? Yes. Are you getting 1 million there? You may get a figure which is not exactly a million because we have rounded off, but it should be a figure of 999 something. Are you getting 1 million, or are you getting a figure of 99? Yes, it should be 1 million. This one will be paid in the following day. Now, having that, we can wind up the question now by doing what? By answering our question. So what are we required to do? We are required to prepare financial statement extract. Financial statement comprises of the income statement, comprises of the statement of financial position. We need to prepare income statement extract. Remember, an extract is part of something. Is part of the income statement. This is not the complete income statement. We are preparing this income statement to show what was supposed to be included in this income statement for 3 years in relation to this compound financial instrument. So let's do that. We prepare income statement extract. Basically to show what the company was supposed to recognize here for 3 years. The first year ended 31st December 2018, 31st December 2019, 31st of December 2020. And what the company was supposed to recognize in the income statement is this interest. This interest. So this interest should be recognized in the income statement as part of the finance cost. As part of the finance cost. So therefore, in the income statement, specifically at the expenses, the company was supposed to recognize this interest, but basically any form of interest will be recognized in the income statement as part of the finance cost. As part of the finance cost. So therefore, the finance cost for the first year is this one, 83,167 In year 2, this one, 85,252, and year 3, 87,524. 524. That is what was supposed to be recognized in the income statement as far as these compound financial instruments are concerned. What about the statement of financial position? Remember, this is still an extract. This is an extract. This part of is not a complete statement of financial position. So, equally for 3 years, 31st December 2018, 31st December 2019, 31st December 2020. So